Okay, let's talk about ethics for your BTE exam. It's a huge topic, but it's simpler than you think. Right off the bat, let's clear up a huge misconception. Just because something's legal doesn't make it ethical. And here's the key difference. Legal is what you must do. Ethical is what you should do. Mixing these two up is a classic mistake that can cost you easy marks. So let's get this straight.
Okay, here's the definition you absolutely have to know. It's about the moral principles guiding our actions.
Think of it this way. Ethics is about doing what's right, even when the law doesn't force you to.
When you see words like these in an exam question, your ethics alarm bells should be ringing.
Okay, theory is great, but how does this actually show up on your exam? Let's take a look.
See, the questions are designed to test your understanding of fairness and integrity, not just legal rules.
Here's a classic case. A company isn't breaking any laws, but hiding stuff from customers? It just feels wrong.
And that's the key. It's legal, yes, but because it's not honest or fair, it's totally unethical.
So if you take away just one thing from all this, please make it this simple idea right here.
And this is so much bigger than the exam. Out in the real world, it's all about your moral compass.
Because that's what it all boils down to, right? That's the real test, in the exam and in life.
Right, let's jump straight in. Welcome to this high-yield explainer on ACCA Business and Technology, specifically focusing on financial statements. Listen, if you're gearing up for the BT1 exam, you are in exactly the right place. Today is all about a rapid-fire, highly focused revision session designed to help you completely smash this exam. We're not just going to sit here and read a textbook together. We are going to actively decode exactly what the examiner wants to see from you. Our goal today? Absolute clarity, so you don't lose a single easy mark.
Now, I need your absolute focus for the next few minutes. The examiner for this paper, they absolutely love to lay traps. They're going to twist definitions, mix up the terminology, and generally try to make you second-guess the absolute basics. But you know what? We aren't going to let that happen. By mastering the foundational accounting concepts we're about to cover, you're going to basically bulletproof your exam technique. So are you ready to dodge those traps? Let's get to work.
Section 1. The accounting building blocks. Okay, let's burn these punchy, one-line triggers directly into your memory. First up, an asset. What is it? It's simply a future benefit. It's a resource controlled by the business that's going to help generate income down the line. Cash, machinery, inventory, all future benefits. Next, a liability. That is a future obligation. It's a responsibility where the business has to pay out, resulting in an outflow of resources. And finally, capital. Those are the owner's funds. It's the owner's actual investment in the business, representing their claim, not a liability to some external party. So, when you see a scenario in the exam, I want you to map it instantly. Is it a benefit, an obligation, or the owner's funds? Now let's contrast two more really vital building blocks: revenue and expense. Revenue is the income you earn from your normal business activities, like sales or service income. The classic examiner trap here is calling literally any cash inflow revenue. Do not fall for it. It absolutely must be from your normal operations. Then we have expenses. An expense is the cost incurred to actually generate that revenue in the first place, things like rent or employee salaries. And honestly, this brilliantly illustrates the most basic logic of business. Profit is simply your revenue minus your expenses, what you earn after what it costs. Keep these two clearly separated in your mind.
Section 2. The accounting equation.
This right here is the absolute core logic of the entire syllabus. State it loudly, write it down, never ever forget it. Assets equal capital plus liabilities. The crucial thing to understand is that a business has resources. Those are the assets. But those resources didn't just magically appear out of thin air, right? They're always funded by someone. They're either funded by the owner, which makes up your capital, or they're funded by outsiders, which are your liabilities. Both sides of this equation must balance perfectly at all times.
So what's really interesting is exactly how the examiner is going to test you on this. They'll throw a scenario at you and ask for the impact. Let's look at the first example. A loan is taken out. What happens? Well, your cash goes up, so your asset increases. But you also owe the bank money, so your liability increases too. Both sides go up, the equation balances. Second scenario, the owner invests cash. The asset goes up, and because it's money from the owner, capital goes up. Asset up, capital up. The equation still perfectly balances. No matter what the transaction is, you have to link both sides.
Section 3. Financial statements demystified.
You really need to heavily emphasize this contrast in your mind. First, the statement of financial position, historically called the balance sheet. This shows your assets, liabilities, and capital at a very specific point in time. It is a static snapshot, literally like a photograph taken at exactly midnight on December 31st. It represents your position. On the flip side, you have the income statement. This shows your revenue, expenses, and profit over a period of time. Think of it more like a video recording playing out over the whole year. It tells an active story of your performance. So, position is a snapshot in time. Performance is a video over a period.
Section 4. Cash versus profit. Honestly, this is the concept that trips up most students when they're sitting in that exam hall. Profit is accounting, cash is reality. You need to deliver that to yourself with strict authority. The examiner will try to trick you into thinking that just because a business makes a profit, their bank account must be overflowing with cash. Wrong. Because of accrual accounting and the matching principle, profit and cash are rarely the exact same number. They measure entirely different things. Let's look at exactly why that happens.
Here is the step-by-step trap. Step 1. You make a sale to a customer, but you do it on credit. Step 2. Under standard accounting rules, you recognize that revenue right now, which means your profit immediately increases on your income statement. But look closely at Step 3. Because it was a credit sale, the cash is not actually received yet. It's just sitting there in receivables. So you have a profit on paper, but literally zero new cash in the bank. This is a classic timing difference. Never, ever assume that profit equals cash.
Before we move on to the final section, let's clear up another massive confusion point: cost versus expense. They sound like the exact same thing, right? But they are completely different. A cost is the amount you actually spend to acquire something. For example, you buy a new machine. That is a cost. But an expense is a cost that has actually been used up in operations to generate revenue. You use electricity to run that machine. That is an expense. The golden one-line trigger to remember here is this: a cost only becomes an expense when it is actually used.
Section 5. Dodging the exam traps. All right, it's time for a rapid-fire rundown of the specific multiple-choice traps the examiner loves to set. I want you to instantly recognize these scenario triggers so you can lock in the right answer incredibly fast. If the scenario asks what shows position, boom, your brain should immediately snap to statement of financial position or balance sheet. If it asks what shows performance, you instantly answer income statement. If they describe a weird situation where profit is earned but there's no cash, you know for a fact they are talking about a credit sale. And if a resource is used in business operations, that is an expense. Memorize these triggers. And on the flip side, here is a very strict warning about the common mistakes you absolutely must avoid. Please do not lose easy marks by falling into these entirely avoidable pitfalls. Number 1, forgetting that every single transaction must keep the accounting equation in balance. Number 2, assuming profit equals cash. We just proved that's an illusion. Number 3, ignoring the timing differences that are created by credit transactions. And number 4, mixing up cost and expense. Remember, a cost is what you acquire, and expense is what you actually use. So if you take away just one single thing from this entire explainer, make it this. Let's deliver this punchy summary one last time. Position equals balance sheet. Performance equals income statement. Snapshots versus videos. If you can just keep this fundamental distinction crystal clear alongside your basic definitions and the accounting equation, you're going to navigate those financial statement questions with absolute ease. Which brings us to our final question for you today. When you finally sit down for that BT1 exam, are you going to fall for the examiner's tricks, or will you use the fundamental accounting equation and these core concepts to prove them wrong? You've got the tools now. You know the exact traps they're going to set. So go in there, stay totally focused, apply the logic, and absolutely smash this exam. You've got this.
Right, let's smash this. We're tackling one of the most important topics for your ACCA exam. It all comes down to a rock-solid system, and that system is what we call internal control. So what's the point? Think of it like a shield and an alarm system for any business. Now, there are two main types. Getting this right is where you'll pick up easy marks. First up, preventive controls. These are your shield. They stop trouble before it even starts. Things like getting approval for payments or using passwords. See? All about building walls. Okay, now for detective controls. These are your alarm system. They find what's already gone wrong. So bank recs, report reviews, they all happened after the fact, reactive, but you definitely need them. So the key difference, the whole game, is just timing. Is it before or is it after?
Right, this is where you get the marks. Let's look at the exam traps they love to set. It's all about the trigger words. See before, that's preventative. See after, that's detective. Seriously, don't mix these up. Examiners love this stuff. Just remember the timing, before or after.
Let's look at a classic preventative control in action: segregation of duties. This is a big one.
The idea is super simple. You never let one person handle a whole process from start to finish.
By splitting the job into record, approve, and review, you make it so much harder for fraud.
Look, if you only remember one thing for the exam, let it be this: preventative is before, detective is after.
So, for a new startup, what's more important on day one? You tell me. Build strong walls or just get good at catching intruders?
Let's just dive right into it, shall we? Welcome to the explainer that's going to completely change how you tackle the ACCA Business and Technology exam. Today, we're bringing that high-octane energy to something absolutely crucial: leadership styles. If you're prepping for the BT exam, you already know this is a massive high-yield area. I mean, the examiner absolutely loves testing this stuff, and more importantly, they love testing your precision with it. So, we're going to break down the exact styles you need to know, and then we're going to expose those sneaky exam traps so you can literally crush these questions with total confidence.
So, let me ask you, are you ready to secure some seriously easy exam marks? Because that's exactly what's on the table for us today. Look, the BT exam isn't just about regurgitating a textbook. It's like a giant puzzle where you just need to recognize the patterns. I'm going to need your complete focus for the next few minutes, because I promise you this: if you can memorize the 3 specific leadership styles we're about to hit, and if you learn to dodge the examiner's classic little traps, you are guaranteed easy marks. Let's lock in and get those points.
All right, let's start right at the absolute top of the control spectrum. Style number 1, autocratic leadership. Now, the magic is right there in the definition. The leader makes decisions alone. I really want you to put strict emphasis on that word alone. This is top-down control, 100%. There's no committee, no voting, no cozy roundtable chats. When you're reading a thick exam scenario and you spot power completely centralized in one single person dictating the path forward, boom, you're looking at an autocratic leader.
Let's quickly fire through the practical pros and cons they're going to test you on. First up, speed. Since an autocratic leader doesn't have to, ask anyone's opinion, they can make incredibly fast decisions. In a crisis, that's a real game changer. But look at that second point. The trade-off is super low employee involvement. You really need to drill in this specific example right here: a manager deciding literally everything without consulting the team. If the exam describes a boss making rapid-fire choices while the team just blindly follows orders, lock in autocratic and move on.
Okay, let's pivot sharply over to democratic leadership and see how this creates, well, a totally different vibe at work. Look closely at the definition on your screen. The absolute trigger word, the one you need to just burn into your brain for exam day, is participate. In a democratic setup, the leader doesn't sit in an ivory tower. The employees actively participate in the decisions. The power and the responsibility is completely shared across the group.
Notice how the pros and cons here are practically the mirror image of the autocratic style? Let's unpack that trade-off. Because you're bringing the team into the fold and actually gathering their input, you inevitably get much better ideas. I mean, more brains equal better or more well-rounded solutions, right? But you pay for that quality with time. You're going to get slower decisions. A classic exam scenario will show a team discussion happening before any final decision is actually made. The leader is still there, sure, but they're acting more like a facilitator, gathering input first.
Let's take a quick second to juxtapose these two directly. I want you to start building mental buckets right now so you don't get tricked when reading some dense, wordy paragraph on the exam. Left bucket, autocratic, leader decides alone. Right bucket, democratic, employees participate. When you're sitting in that exam hall staring at the screen, ask yourself immediately, is this leader acting like an isolated dictator, or are they actively bringing the team in to participate? Answering that single question will basically hand you the correct answer.
All right, now let's swing that pendulum all the way to the absolute other extreme. Introducing our third and final style, laissez-faire leadership. Let's bring the energy up for this one because it is all about total freedom. As the definition spells out, this is a style where employees make their own decisions. Laissez-faire basically translates to let it be or leave it alone. The leader takes a massive step back and just hands the steering wheel entirely over to the team.
Breaking down the traits here, we hit the ultimate trade-off. You give the team sky-high freedom, but the cost? Super low guidance. The leader basically points to the destination, but gives absolutely zero map on how to get there. Pay attention to this exact example because you will definitely see it on the test. It's when the team chooses exactly how to complete the task themselves. If the scenario gives you a manager who assigns a project and then just walks away, leaving the entire how-to up to the staff, you have found your laissez-faire trigger.
Okay, listen up because this high contrast comparison right here catches so many students off guard. You absolutely must know the crucial difference between democratic and laissez-faire. Here's the breakdown. Democratic means participating. The team is involved, maybe they're even voting, but the leader is still very much present, guiding the ship and finalizing the direction. Laissez-faire, on the other hand, means total freedom. There is essentially zero direction from the leader. Do not, I repeat, do not confuse a team simply having the say with a team having total control.
Right, we've nailed the theory. Now, let's dramatically shift gears here. Welcome to the trap room. This is where we stop just learning concepts and start directly beating the examiner at their own game. The ACCA examiner is super clever, okay? They know exactly where you guys get confused, and they design these scenarios specifically to bait you into picking the wrong answer. But we're going to expose those classic tricks right now, so you can literally just walk right past them.
Let's rapid fire through this exact table. We pulled this straight from the highest yield revision notes, and you need to just drill these direct links into your brain. If the scenario explicitly states the leader decides alone, your reflex must be autocratic. If you read that the team votes on a decision, you instantly lock in democratic. And if the text reveals that the leader gives no direction whatsoever, you confidently hit laissez-faire. Make these connections totally automatic so you don't even have to second-guess yourself on the big day. To condense this whole shebang into something you can carry straight into the exam hall, here is your ultimate one-line summary mnemonic. I'm giving you a strict imperative right now. You have to memorize this exact phrase. Auto equals leader. Demo equals team. Laissez equals free. Actually say it with me. Auto equals leader. Demo equals team. Laissez equals free. The second you sit down at your computer for that BT exam, write this down on your scratch pad. It is your absolute safety net.
We've covered the definitions, we've broken down the trade-offs, we've successfully mapped out the examiner's trap room, and you've got your master mnemonic ready to go. So, I just have one final question for you. Are you ready to pass? Because armed with this specific, structured knowledge, you absolutely are. You know exactly what triggers to look for now. You understand how these concepts actually operate in those tricky scenarios. Take this knowledge, keep that focused energy sky high, and go absolutely crush the ACCA BT exam. You've totally got this.
Welcome back to The Explainer. Today, we're tackling a massive, incredibly high-yield topic that shows up constantly in the ACCA Business and Technology exam. Listen, if you want to secure those easy marks and absolutely conquer the BT syllabus, you really need to understand the fundamental core of what makes employees tick. I am, of course, talking about motivation. Now, we aren't just going to look at dry, boring textbook theories today. We're diving straight into the ACCA notes to uncover exactly how the examiner tests this stuff, what they actually want to see from you, and the precise phrasing that's going to get you maximum points. So let's get right into it. Right off the bat, you have to ask yourself, what truly drives performance in the workplace? Is it a fancy new office? Free coffee in the break room? Maybe a super strict boss? Well, when you are sitting in that exam hall, you need to strip away all of that fluff and focus purely on the fundamental engine of human behavior at work. Because, the examiner isn't looking for some grand philosophical debate here. No way. They are looking for a highly specific mechanism, one that connects an employee's internal state directly to the output they deliver for the business. Okay, let's dive into this. Here is the foundational, exact definition the examiner expects you to know cold. Motivation is the willingness of employees to work effectively. Now, notice those two absolutely crucial words there, willingness and effectively. It's not just about showing up and clocking in, right? Anybody can do that. It's about the internal drive to actually execute the job well. If a scenario in your exam describes a workforce that is sluggish, making a ton of errors, or just doing the bare minimum, you are staring right at a motivation problem. Let's look at a rapid-fire, real-world exam scenario. So a company announces a year-end bonus for hitting their sales targets. What happens next? The bonus is given, the employee works harder, and boom, motivation increases. It's a very direct cause and effect chain. The examiner absolutely loves to present you with an action taken by management, like handing out a bonus, and then ask you to identify the resulting impact. You need to be able to instantly spot that the bonus is the trigger and that increased effectiveness, that is the direct result of the spiked motivation.
Now, knowing the definition is a great start, for sure, but to really dominate this section, you need a framework. Enter the ultimate weapon, Maslow's hierarchy of needs. The ACCA notes reveal this as an incredible diagnostic tool for the BT exam. Please do not treat this as just some dry historical theory that you memorize and forget. Treat it as your primary mechanism for solving exam scenarios. The examiner will almost always use Maslow to test if you can map a specific management action directly to a specific human need. Mastering this ladder is quite literally your golden ticket to securing those marks.
Let's move to and see how this builds. Let's climb this 5-level ladder together, and as we do, I want you to mentally pair each need with its exact real-world exam equivalent. Step 1 is basic needs. In the exam, this is almost always represented by salary. Step 2 is safety. Think job security, safe working conditions, or maybe a permanent contract. Step 3 is social. This is team belonging, the water cooler chats, just that feeling of being part of a group. Step 4 is esteem. This is all about recognition, getting a fancy job title or winning an award. And finally, the peak, step 5, is self-growth. This is personal development, taking on challenging new projects and really reaching your full potential.
And this brilliantly illustrates how that actually looks in action. Let's say the exam question states, Sarah was recently made senior manager after successfully leading a major project. What need is being satisfied there? Well, it's a promotion. The promotion makes the employee feel valued and recognized by her peers and her bosses. Therefore, her esteem need is satisfied. It's a clean, direct link. You see the word promotion or award in a question, your brain needs to instantly lock onto esteem.
Let's hit them with another rapid-fire example. The scenario reads, the company organizes a weekend retreat and a Friday evening bowling league. So, what is management trained to achieve here? They are organizing a team outing, which improves bonding and camaraderie. Bam! That directly targets the social need. In the exam hall, honestly, don't overthink it. If it involves groups, teams, or interpersonal relationships outside of strict work tasks, you are looking straight at the social level.
All right, tutor's secret time. Let's look at the source notes to see where students typically get tripped up. The examiner isn't just going to ask you to gently recite the 5 levels of the hierarchy. No, they are going to give you a messy, mixed-up scenario and actively try to bait you into choosing the wrong need, or worse, trap you into wasting your precious time. You have to be ready to spot and dodge these specific traps when you're sitting there under pressure. Now, what's really interesting about this slide is that the trick to beating these traps is just memorizing these exact scenario-to-need mappings. If a scenario says salary increase, you select basic. If they mention job security or maybe a pension plan, you select safety. If it's team bonding, you hit social. And if it's a promotion, it is absolutely esteem. The examiner will definitely try to mix these up. For example, they might try to suggest a salary increase satisfies an esteem lead. Now look, while it might make you feel good in the real world, in the strict, rigid confines of this exam framework, salary is basic. Stick to the mappings. We need to urgently pivot here, because simply knowing the right answer is really only half the battle. The other half, it's avoiding the common mistakes that cost otherwise well-prepared students easy marks every single sitting. I see it literally all the time. Students know the material, they know Maslow inside and out, but their exam technique completely betrays them. Let's fix that right now so you don't fall into the exact same pitfalls. Here is the absolute biggest time waster and mark killer you can possibly commit, writing out the full, lengthy theory of Maslow's hierarchy in your answer. Guys, the examiner does not want a history lesson. They know perfectly well who Maslow is. Writing out big paragraphs of theory scores you 0 marks, 0. Instead, you must actively link everything directly back to performance. If you identify a basic need being met, immediately state how satisfying that need increases the employee's willingness to work effectively. Performance is the finish line. Always, always make sure you cross it. So the crucial point is summarized perfectly in this one simple line. If you take away absolutely nothing else from this explainer today, let this be cemented into your brain before exam day. Motivation drives performance. Every single scenario, every multiple choice option, every written requirement related to this topic revolves completely around this central axis. If a management action doesn't ultimately drive performance, well, it simply isn't effectively motivating. So think about the very next practice question you do on this topic. I want you to consciously force yourself to draw a straight, undeniable line from the scenario through Maslow's hierarchy and directly to business performance. Stop reciting theory and start actually solving the business problem in front of you. How are you going to make that link in your next answer?
Keep that focused energy, apply these frameworks flawlessly, and go absolutely crush that BT exam. Thanks so much for joining me on this explainer, and I'll catch you on the next one.
Welcome to This Explainer. Listen up, because today we are locking down a highly tested topic straight from your ACCA Business and Technology notes, organizational structure. We're going to break down the exact differences between the functional and divisional setups, totally demystify the concepts, and make sure you're absolutely ready for exam day. Let's get into it. Now, you might be wondering, could you actually spot the difference between these two when the clock is ticking on exam day? Because the examiner is absolutely going to test you on this. It's one thing to just read definitions, right? But it's a completely different ballgame to identify them hidden inside a complex scenario. By the end of this explainer, you'll have the exact mental framework you need to spot those examiner tricks from a mile away.
Okay, Section 1, Structure Types Explained. You need to lock this definition into your memory right now. A functional structure is an organization divided strictly based on its functions. So what does that actually mean for us? Basically, it means the business is carved up based on the specific activities or skills of its people. The whole architecture of the company is built around grouping individuals who do the exact same type of work.
To make this a bit more concrete, just think of your standard, everyday corporate departments. You've got a finance department where all the accountants sit crunching numbers. You have an HR department handling all the employee stuff. You've got marketing driving the sales, and operations just keeping the lights on. That is your classic functional setup. Literally, if you walk into an office building and floor 1 is all marketers and floor 2 is all IT pros, you're looking at a functional structure. They are grouped purely by the activity they perform.
Moving on to Section 2, the divisional setup.
All right, let's flip the script and look at the alternative. This happens when companies realize that grouping by activity just isn't cutting it for their specific game plan. A divisional structure completely changes the basis of division. Instead of separating people by what they do, the whole organization is separated by product, by region, or by customer. The structure is entirely focused on the end result, not the internal process. It's a massive shift. It's kind of like creating mini companies within the larger corporate umbrella.
So how does this actually look in the real world? Well, if you see a company split into a North American division and a European division, boom, that's a regional division. Or maybe a huge tech company has a separate unit just for smartphones and another totally separate unit just for laptops. And here's the kicker. Each of those units will actually have their own marketing and finance people tucked inside them. Because the division is based on the specific product or region, that is definitively a divisional structure.
All right, Section 3, Functional versus Divisional.
Let's put these two head to head. Looking at the basis row here, a functional structure is based on activity, while a divisional structure is based on output. Simple enough, right? But now, look at the focus row. This is key. Functional structures focus on specialization, becoming the absolute best at one specific task like accounting or marketing. Divisional structures, on the other hand, focus on the product or the market. They make sure that a specific customer base or product line gets total dedicated attention. Seriously, burn this table into your brain.
Which brings us to Section 4, ACCA Exam Traps.
Okay, pay close attention here, because the examiner isn't just going to ask you for a textbook definition. They're going to give you a story to diagnose. Here's the first trap, straight from the examiner's playbook. If the scenario simply says the company has quote-unquote departments like HR and finance, what are you choosing? Take a second. Look closely at those keywords.
Nailed it. The answer is functional. Why? Because HR and finance are activities. They represent specific corporate functions. The examiner is literally handing you the answer by telling you the company is dividing its people by the activity they perform. Don't overthink it. Just trust the framework we just built.
Let's try the next one. Imagine you're reading this really long paragraph on the exam, and buried right in the middle, it casually mentions that the company is divided into Product A and Product B. What's the correct structure here?
Yep. Absolutely, it's divisional, because the focus has shifted entirely to the output. Product A and Product B are outputs, they are not activities. The exact moment you see the business splitting itself up to focus on a specific market offering or geographical region, you can confidently lock in divisional as your answer.
So the absolutely crucial point is this. Please do not fall into these common examiner traps. Year after year, students lose easy marks by confusing both structures, or worse, just completely failing to identify the exact basis of division hidden in the scenario text. When you're reading a question, you gotta become a detective. Ask yourself, What is the basis of this division? Is it an activity or is it an output? If you let that single question guide you, you'll get to the right answer every single time.
Almost done. Section 5, the one-line summary.
Okay, this is the golden nugget you need to lock into your short-term memory for exam day. Ready? Functional equals activity. Divisional equals output. That is the entire concept distilled down into its absolute purest form. If you remember literally nothing else from this explainer, remember those 6 words. Functional equals activity. Divisional equals output. So with this crystal clear framework now locked in your mind, what other hidden structures around you are quietly dictating how the business world operates without you even realizing it? Keep that curiosity alive, keep studying hard, and you are absolutely going to crush this exam.
Welcome. If you're listening to this, you're looking to crush your ACCA BT 1 exam, and more importantly, you want to dodge the examiner's traps. Today's explainer? It's all about bagging those easy foundational marks. We're stripping away the textbook fluff and zeroing in on just 4 words: capital, revenue, expense, and profit. Let's get right into it. Now, I can almost hear some of you sighing, thinking, capital, revenue, expense, profit? Seriously? We learned this on day 1. But look, here is the brutal truth. Being overconfident with these absolute basics is exactly where the examiner gets you. They're banking on the fact that you'll just skim a question, assume you've got it, and click the wrong box. Well, not on our watch.
So here is our game plan for today's explainer. 1. The foundational 4. 2. Capital, the owner's claim. 3. Revenue and expense. 4. Profit, the ultimate metric. And 5. Dodging the exam traps.
All right, section 1, the foundational 4. Let's master the basics. Our very first pillar is capital. By definition, capital is simply the owner's investment in the business. It represents the owner's claim. Now, I need you to mentally highlight this. Capital is the owner's money. It's completely internal. It is absolutely unequivocally not a liability owed to some external party, like a bank or a supplier. And honestly, this is the classic trap students fall right into year after year. Picture this. A scenario describes money being injected into the business. You panic. You click liability to external parties. When in reality, it was just the owner putting in cash. Boom. You lose the mark. Listen, the correct answer, every single time the owner invests, is capital. So your absolute golden rule to take away here. Capital equals owner's funds. Say it out loud. Write it on a sticky note, do whatever you need to do. When you're sitting in that exam hall and you spot the phrase owner's investment, your brain should immediately scream capital. No second guessing. Moving on to section 2, revenue and expense. Let's get operations decoded.
First up in the day-to-day operations, we have revenue. The strict definition here is income earned from normal business activities. Think your everyday sales or your regular service income. And I really want you to fixate on that exact phrase, normal business activities. We aren't talking about a one-off sale of your old factory building here. It's the routine, daily grind of selling whatever your core product or service is.
Which brings us to another massive exam trap. The examiner absolutely loves to play vocabulary games with you. They'll throw in the phrase income from operations. And a stressed out student, well, they might freeze, wondering if that's some weird, special category of profit. Guys, it's not. Income from operations literally just means revenue. Wire those 2 phrases together in your brain permanently. Now, on the flip side of the coin, we've got expense. An expense is simply the cost incurred specifically to generate that revenue we were just talking about. It's the necessary sacrifice, right? You literally cannot make sales without paying your staff. So things like your salary payout, the monthly rent, the electricity bill, these are the unavoidable costs of running the show. They are your expenses.
Okay, pay really close attention here because this comparison is tested all the time. Say you buy a brand new heavy-duty machine. That money spent to acquire an asset, that's a cost. But when you use electricity to actually run that machine on a Tuesday, that's a cost consumed in daily operations. That is an expense. The golden rule to remember: a cost only becomes an expense when it's actually used.
To sum that up, here are the 3 rules you need to lock in right now. First up, revenue equals income earned. Second, expense equals the cost of earning that revenue. And third, a cost becomes an expense when used. Memorize these and you'll be knocking out related multiple choice questions in under 10 seconds flat. Seriously. All right, Section 3, Profit, the ultimate metric, calculating performance. Here it is, the golden equation of business performance. Profit equals revenue minus expenses. It is the ultimate, undeniable indicator of how well your business is actually doing. It simply means what you've earned after all your costs have been stripped away. At the end of the day, it's the one metric every single shareholder is looking at. Section 4, Dodging the exam traps. The cash versus profit illusion. There is a really sharp contrast here that you absolutely have to grasp. Profit is an accounting concept. It's built entirely on accruals and matching principles. Cash, on the other hand, is actual, physical money sitting in the bank. I need you to hear me loud and clear on this. Profit does not equal cash. Mixing these two up in the exam is basically a fatal error. Let's just walk through a quick scenario to prove exactly why this happens. Step 1, you make a huge sale to a customer, but you do it on credit. Step 2, because you made that sale and technically earned the revenue, your profit goes up immediately based on standard accounting rules. But Step 3, because it was a credit sale, the actual cash hasn't been received yet. So your profit just spiked, but your bank balance? Still completely flat. So hammer this single sentence into your memory right now. Profit is accounting, cash is reality. If you ever come across a scenario where profit is earned but there's no cash to show for it, instantly recognize it as a credit sale or just a timing difference. Please never ever fall for the profit equals cash trap. And finally, Section 5, Dodging the exam traps. Let's do a rapid-fire review. Let's lock these 4 triggers into your memory before we wrap up. Ready? Capital, owner funds, revenue, income earned, expense, cost to earn revenue. Profit, revenue minus expense. This right here is your ultimate defense shield against the examiner's tricks. When you see the concept, I want you to just fire the trigger. So, you know the definitions now, but the real test is spotting the traps under the ticking clock of the exam. Remember, capital is never a liability. A cost is not an expense until it's actually used. And profit? Definitely not cash. Master these, and those marks are basically yours. But before you go, it begs a much larger question for you to ponder. If profit really doesn't equal cash, how long can a highly profitable business survive if its bank account is entirely empty? Good luck studying. All right, welcome to this rapid-fire explainer. If you're gearing up for your ACCA Business and Technology exam, BT1, you are in the exact right place. I'm going to grab you by the shoulders and walk you through the absolute essentials to pass this thing. We're doing a comprehensive, combined summary of the entire ACCA BT1 subject today. We're zooming in on those high-yield topics, and most importantly, we are going to expose the common exam traps that catch so many students out. So, we're taking this massive syllabus and carving it up into 5 unshakable pillars: governance and agency, risk and controls, business structures, leadership and motivation, and finally, accounting basics. Master these, and you'll easily dodge the examiner's traps. Let's dive right into Pillar 1, governance, ethics, and agency. So what actually is corporate governance? The absolute must-know concept here is that governance is strictly about oversight. Think of the board of directors as the referees. They aren't actually playing the game, right? They're just making sure management plays by the rules. It's all about protecting stakeholders and improving accountability. If you're reading a question and you see words like oversight, transparency, or control, your brain should immediately scream governance. Now listen, do not fall for this classic exam trap. Say you're reading a scenario where a CEO has way too much power, or maybe the board just isn't paying attention to what's happening. Is that a management failure? No way. That is a governance weakness. The failure lies entirely in the lack of oversight. Let's put them side by side to clear it up completely. The board sets the direction and monitors what's happening. That's governance. Management? Well, they're the ones actually getting their hands dirty, executing the work, and running the daily operations. It flows downwards. Owners rely on the board for oversight, and the board relies on management for execution. Keep those two separate in your mind. Which naturally brings us to the agency problem. Honestly, think of this like handing a teenager your credit card to go buy groceries. Their incentives? Probably not going to align perfectly with your budget. It happens when managers act in their own self-interest instead of the shareholders. Because ownership doesn't equal control, a conflict pops up. The agency problem hits when managers do things like avoid a profitable risk just to protect their own jobs. Or maybe they just focus entirely on hitting their personal bonus targets. If those incentives aren't aligned, boom, you've got an agency issue. Moving right along to Pillar 2, risk and internal controls. Okay, you need to lock the ARDA acronym into your brain right now. Avoid, reduce, transfer, accept. This is how businesses respond to risk. If a company completely cancels a risky project, they're avoiding it. If they add controls or start employee training, they're reducing it. Now, what if they buy insurance? They are transferring the risk to someone else. Please don't fall into the trap of thinking that buying insurance avoids a risk. It literally just transfers the financial hit. And finally, accepting is just taking no action, but setting aside a little budget for small, expected losses. Internal controls. Guys, this is a massive, high-probability trap on the exam. It is all about timing. Preventative controls are like the deadbolts on your front door. They stop the burglar before they get in. Think approvals, passwords, segregating duties. Detective controls, those are your security cameras. They catch the burglar after the fact. Things like a bank reconciliation or a performance review. So if a company introduces a dual approval system before a payment ever goes out, that's preventative. All right, moving at lightning speed into Pillar 3, business structures and organization. Let's strip down the definition of a company. The absolutely crucial thing to remember here is that a company is a separate legal entity from its owners. It has limited liability. That means the company itself can own assets, sign contracts, or take out loans in its own name. And because of limited liability, shareholders only stand to lose the money they invested, which completely protects their personal assets like their houses and cars.
Okay, look closely at public versus private companies. A huge mistake students make is thinking, oh, it's a massive company with lots of investors, so it must be public. Actually, no, it is 100% about the shares. A public company's shares are traded publicly on a stock exchange, which naturally brings a ton of high regulation. A private company, their share transfers are restricted and they deal with lower regulation. So public equals listed, private equals restricted. Simple as that. Internally, companies have to pick a structure. You've got the functional structure, which chops things up by activity, your HR, finance, marketing departments. And then you have the divisional structure, which chops things up by output, like specific products or maybe geographic regions. If your exam scenario mentions separate business units for product A and product B, that is definitely a divisional structure, not functional.
Here we go, Pillar 4, leadership, management, and motivation. This is an absolute gold mine for easy points. You have to tell leadership and management apart. Leadership, that's all about setting a vision, inspiring people, focusing on the future, and driving change. Management is about execution, controlling the work, focusing on the present day, and maintaining stability. Vision equals leadership, control equals management. Spot those keywords, and you've got the points. Now for motivation. We've got Maslow's hierarchy of needs. When the examiner throws a motivation question at you, just map the scenario straight to these steps. A pay bump, that satisfies a basic need. Job security hits the safety need. Team bonding exercises, that fulfills social needs. And a big promotion, boom, that hits esteem, making the employee feel valued. Don't waste time writing out the full theory in your head. Just quickly link the scenario to the specific need. You also need to know your leadership style's absolutely cold. If a manager makes all the decisions solo, no input from anyone else, that's an autocratic style. If the team actually votes or discusses things before a final decision, that's democratic. And if the leader just steps back and says, hey, you figure it out, offering no real direction, that's laissez-faire. Auto means the leader decides. Demo means the team decides. And laissez means the team runs free. And finally, we arrive at Pillar 5, basic accounting and finance. Let's strip away all the stuffy jargon here. An asset, it's simply a resource that gives you a future economic benefit. It's going to help you generate income. A liability, a future obligation you've got to pay. Capital is just the owner's funds or investment. Revenue is the income you earn from your normal day-to-day activities. And an expense is whatever cost you incurred to earn that revenue. Keep these one-liners in your back pocket. These terms feed right into the holy grail of financial reporting, the accounting equation. Assets equal capital plus liabilities. Think about it. A business has resources, its assets, and those resources have to be funded somehow, right? Either by the owner, which is your capital, or by outsiders, which are your liabilities. Your assets literally must always equal the sum of those funding sources. Let's test this out with a classic trap. If an owner invests cash into the business, what happens to the equation? Just ask yourself how the balance shifts. You have more cash, so your assets go up. And because the owner put it in, capital goes up, right? What if you take out a bank loan? Well, assets go up because you got the cash, but liabilities also go up. Always link both sides of the equation. Before we wrap this explainer up, burn these common mistakes into your memory. Misreading the scenario is a killer. Read the whole thing and figure out what's actually happening. Confusing governance and management? Remember, oversight versus execution. Mixing up preventative and detective controls? Just ask yourself, does this control happen before or after the mistake? Fix these little things, and you'll save so many easy marks. And that is the whole shebang. You are now armed with the frameworks, the one-liners, and the trap fixes to absolutely dominate the ACCA BT1 syllabus. You know the difference between oversight and execution, you've got your risk responses locked in, and your accounting equation is perfectly balanced. So the only question left for you is, which exam trap are you going to dominate first?
Hey everyone, and welcome to this explainer. I am absolutely pumped you're here today because we're going to lock down those easy must-have marks in the ACCA Business and Technology Communication topic. If you're currently prepping for your ACCA BT exam, well, you already know the deal. Time is tight, and literally every single mark counts. But here's a little secret. There are actually certain topics where the examiner practically hands you the points on a silver platter, as long as you know exactly how to play their game. So let's dive right into this, and make sure you walk into that exam room completely bulletproof.
Let's kick things off with a pretty brutal, honest question. Are you dropping points on the absolute easiest section of the exam just because you aren't paying attention to the examiner's tricks? Look, it happens to the best of us. You study all those complex theories, you memorize the really hard formulas, and then you get to a super simple question about communication and you overthink it, you start second-guessing yourself. The examiner knows exactly how to make a totally straightforward concept look, well, tricky in a scenario. But today, we're going to fix that for sure.
All right, section 1. What is true communication? Let's get back to basics.
So here's your textbook definition, and you need to know this cold, like recite it in your sleep level of cold. Communication is simply the process of sharing information. That's it. It isn't just about talking loudly in a room or sending a beautifully formatted report. At its very core, the ACCA syllabus defines this simply as a process. Information has to successfully move from point A to point B.
And honestly, this brilliantly illustrates our one-line golden rule for this entire topic. Communication is all about sharing the actual meaning, not just throwing words at someone. Think about it. If you speak for a solid hour, but the other person doesn't understand your core message, communication hasn't happened. It just failed. And let me tell you, the examiner loves to test this exact distinction. They're going to give you a scenario where, say, a manager sends out an email, but the team completely misinterprets it. Your job is to spot that. Because the meaning wasn't shared, the whole communication process broke down.
Moving right along to section 2, 2 types of communication. We'll be comparing verbal versus written. You've got to instantly recognize the difference between verbal and written communication the second you see them pop up in a scenario. Verbal communication is basically your face-to-face speaking and your team meetings. Written communication, that's your emails, your formal reports, your memos. Now, I know what you're thinking, this is incredibly simple, right? But you'd be surprised how often students just skim past these details in the exam. When a scenario specifically says an email was sent, your brain needs to immediately flag the word written. If it mentions a boardroom discussion, boom, flag it as verbal. Building this quick recognition muscle is a total game changer and saves you crucial minutes.
Which brings us to section 3. Beware the communication barriers. It's time to spot the traps.
Okay, these are the 3 specific roadblocks you have got to hunt for in the exam text: language issues, physical or mental noise, and complete misunderstanding. When you're reading a scenario, you need to be like a detective looking for clues. Did they mention that the staff spoke different native languages? Or maybe they used heavy technical jargon that the other department didn't get. Boom, language issue. Was there literally loud machinery humming in the background, or was the receiver just way too stressed out to listen? That's noise. Or did they just completely get the wrong end of the stick? That is a classic misunderstanding.
So, here is the absolutely crucial takeaway. If a scenario says someone misinterpreted an email, do not overthink it. That is a communication failure caused by a barrier, plain and simple. I see students all the time trying to link a misunderstood email to some complex management theory or agency theory or something else entirely. No way. If the email was read wrong, it's a communication barrier. Keep it simple, grab your easy mark, and move on.
All right, section 4, dodging the exam traps through pattern recognition.
We're going to do a quick rapid-fire drill on this pattern recognition right now because you need to build this as a reflex. Ready?
If they say email sent in the scenario, you say the answer is written. If they say meeting discussion, you say the answer is verbal. If they say message misunderstood, you say the answer is communication barrier. The examiner writes these scenarios using very specific trigger words. If you can map those trigger words to the correct concepts, you literally bypass all the confusion and go straight to the right answer. It's like a giant puzzle, and it really just comes down to pattern recognition.
Next up, Section 5, Fixing Common Student Mistakes and How to Stop Overcomplicating Everything.
Look, step 1 is you've got to stop ignoring the barriers hidden in the text. Read the scenario fully and identify what is actually happening. If they go out of their way to mention a noisy factory floor, well, it's there for a reason. Step 2, stop overcomplicating things. I really cannot stress this enough. If you see a language difference, mark it as a communication barrier and just move on. Don't sit there for 3 minutes debating if it's an organizational structure issue. Choose the most direct answer and trust your training.
Finally, Section 6, Final Exam Motivation. Let's outline your bulletproof strategy.
Okay, you need to get onto that ACCA practice platform like yesterday. And when you do those multiple choice questions, timer strictly on. You've got to get used to the pressure of the clock ticking down. When you get something wrong, and you will, we all do, review every single mistake deeply. Figure out exactly why you chose the wrong option. And finally, attempt full mock exams without ever hitting the pause button. 2 full hours straight through. You've got to train like you fight.
Here is a game-changing personal tip straight from our source material. Take a screenshot or a photo of your wrong answers on your phone. Look at them every morning when you wake up and every night before you go to sleep. Seriously, you will learn far, far more from your mistakes than from just passively reading your notes over and over. By reviewing your errors daily, your brain is going to start recognizing these exact patterns and examiner traps when you finally sit down for the real thing.
So I'll leave you with this final thought. Are you going to let the examiner trick you out of easy points with a simple misunderstood email scenario? Or are you ready to lock down this knowledge, spot those communication barriers instantly, and absolutely pass this exam? The strategy is right in front of you. Now go execute it. Thanks so much for joining me on this explainer, and happy studying.
Welcome to this Ultimate Explainer. Today, we're diving into a massive, comprehensive compilation covering the entire business and technology subject. We're taking all those distinct chapters and topics and rolling them into one high-energy session. We're literally going to sprint from the top of the corporate ladder all the way down to the foundational numbers, hitting the biggest concepts and the sneakiest traps along the way. Let's get into it. Here's our battle plan for today. We're covering 1, governance and ethics, 2, internal controls and risk, 3, business structures, 4, leadership and motivation, and 5, accounting fundamentals.
Starting right at the top with Section 1, Governance and Ethics. This is all about directing and controlling the business.
If you take absolutely nothing else away from this first section, make it this: governance equals oversight. It's fundamentally about monitoring and controlling the folks who run the daily operations, rather than stepping in and running things yourself. It's that absolute crucial layer of accountability that protects everyone involved.
You see, it's super easy to mix these two up, but they are totally different. Governance is the high-level stuff: oversight, accountability, and monitoring. Management? That's your boots on the ground. They're executing the plans, handling the daily grind, and actually implementing the strategy. Governance is basically the board of directors looking down, making sure the managers are actually doing their jobs right. Now, let's look at a classic trap that trips people up. Imagine a manager deliberately avoids a risky but highly profitable project just to protect their own safe paycheck. Taking that risk could have generated massive wealth for the company's owners, but the manager played it safe. So what's the core issue happening in this dynamic?
We call this the agency problem. And it happens because, at the end of the day, ownership does not equal control. The people managing the money aren't the ones who actually own it. So naturally, you get these situations where managers might act in their own self-interest, like protecting their job or chasing a personal bonus, instead of doing what's best for the actual shareholders.
Moving right along to Section 2, Internal Controls and Risk. This is where we look at safeguarding the business.
Okay, timing is absolutely everything here. Preventive controls are designed to happen before an error even occurs. Think of needing a password or getting a manager's sign-off before a huge payment goes out. Detective controls, on the other hand, happen after the fact. That's your audits or bank reconciliations, where you're basically trying to catch a mistake that already slipped through the cracks.
Let's test this with another high probability trap. Imagine a brand new competitor suddenly enters your market. When you're categorizing this threat, is it an operational, a financial, or a strategic risk? What do you think?
If you guessed strategic, you hit the nail on the head. A new competitor is a long-term strategic risk because it shakes up your fundamental business model. Don't confuse it with operational risks, which are just daily hiccups like a system crashing or a staff typo. And financial risks? Those are strictly money-related, like crazy currency fluctuations or sudden interest rate spikes.
So, how do we handle all these threats? Just remember the 4 main responses: avoid, reduce, transfer, and accept. And here's a huge misconception you have to watch out for. Buying insurance? That is a transfer of risk, not a reduction. By buying a policy, you're literally just shifting the financial burden to someone else. You aren't actually reducing the chance of the bad thing happening in the first place.
All right, Section 3, Business Structures. Let's talk about organizing for success.
First up, what actually is a company? Fundamentally, it's a completely separate legal entity from its owners. It's like its own person. Because of this separation, the company can own assets and sign contracts completely independently. And the best part is that it offers limited liability, meaning if things go completely south, shareholders usually only lose the money they put in. Their personal savings stay totally safe.
But you gotta know the difference between public and private companies. Public companies have publicly traded shares, which means wide ownership, but it also means dealing with massive amounts of regulation. Private companies, their shares are not on the public exchange, so they have restricted ownership, but hey, a whole lot less red tape to deal with.
Now, how do we organize the people inside those entities? You generally have 2 choices. A functional structure divides everyone by what they do, so all the numbers people in finance, all the recruiters in HR. It's all about specialization. A divisional structure, though, divides the business by output. So you might set up entirely separate divisions for different product lines, or maybe for North America versus Europe.
On to Section 4, Leadership and Motivation. Let's dive into managing the people.
There is a massive, fascinating difference between leadership and management. Leadership is all about the future, inspiring a vision and driving real change. Management, however, is grounded right here in the present. It's about controlling the execution and keeping everything stable and reliable. They are totally distinct skill sets, but a successful business absolutely needs both.
When it comes to getting the most out of your team, we have to talk about Maslow's hierarchy of needs. You build it up step by step, starting with basic salary, then job safety, social belonging, esteem, and finally self-growth. Here's a great little detail to keep in mind. Getting a promotion? That doesn't satisfy a basic or social need. That goes straight to satisfying the esteem need.
You also need to consider who's actually making the decisions. In an autocratic style, the boss decides everything alone. It's super fast, but team involvement is basically zero. A democratic style brings the team in. You usually get way better ideas, but decisions take a lot longer. In laissez-faire, that's total freedom. Employees choose their own path, but with almost no guidance from the top.
And finally, Section 5, Accounting Fundamentals. Time to measure the success.
Let's boil down the absolute must-know accounting terms. An asset? That's just a future economic benefit. A liability is a future obligation, money you owe someone else. Capital represents the owner's actual investment. Revenue is the income you earn from your operations. An expense is what it costs you to get that revenue. And profit is simply revenue minus expenses.
And all of that feeds directly into the unbreakable rule of accounting. Assets equal capital plus liabilities. Think of it like this. A business has resources, right? Those are its assets. And every single one of those resources is funded in one of 2 ways. Either the owners paid for it, which is capital, or you borrowed from outsiders, which are liabilities. Every single transaction has to balance perfectly across these.
Okay, here's an absolute game changer of a concept. Profit does not equal cash. Profit is just an accounting concept. Because of rules like accruals, if you make a huge sale on credit, boom, your profit goes up instantly on paper. But guess what? Since the customer hasn't actually paid you yet, you don't have a single extra penny in your actual bank account.
Wow, we have covered some serious ground today in this explainer, sprinting all the way from boardroom oversight straight down to the core accounting equation. Based on everything we've just unpacked across these frameworks and principles, have you mastered the traps, or is your knowledge still a liability? Thanks for joining me on this deep dive.
Okay, let's just dive right into this high-octane revision explainer. We're going to bulletproof your ACCA BT1 exam technique today. Look,
If you're preparing for business and technology, you already know that financial statements can feel, well, kind of like a minefield. The examiner isn't just checking if you've memorized the book, they're testing your absolute precision. So today, we're strictly focusing on the financial statements module from the ACCA BT notes. We're going to break down exactly what you need to know and, more importantly, the traps you absolutely need to dodge.
I need your absolute focus right now. We're going to sprint through the exact traps the examiner is literally just waiting for you to fall into. We'll strip away all the fluff, focus on the high-yield concepts, and basically build this strict logic that you can apply to every single scenario question they throw your way. Sound good? Let's get to it.
All right, level 1, the vocabulary, securing the foundations. We literally cannot conquer the statements until we master these building blocks, so let's lock down the vocabulary right now.
Let's strip these definitions right down to their core timeline. Honestly, don't overcomplicate it. An asset? That's simply a resource you control right now that's going to provide some future economic benefit. Think of it like a tool, machinery, inventory, or cash that helps you generate income tomorrow. A liability, on the other hand, is a future obligation. It's this heavy responsibility hanging over you that guarantees an outflow of your cash down the line, like a bank loan or having to pay your suppliers. So, if an exam scenario mentions a future benefit, boom, the answer is asset. A payment obligation? Yeah, for sure, that's a liability.
Now, let's contrast those items with your day-to-day operations. Revenue is basically the lifeblood of the whole thing. It's the income you earn from your normal, everyday activities, like making sales or doing client services. An expense, though, is the unavoidable cost you have to incur strictly to generate that revenue. We're talking rent, electricity, paying your staff. The exam trap here is super simple. If a scenario asks about income from operations, you know that's revenue. If it asks about the cost of running the business, that's your expense.
But hey, you really gotta watch out for a massive exam trap here, confusing a cost with an expense. Seriously, memorize this golden rule. Cost becomes an expense when it's actually used. So what does that mean in plain English? Well, the money you spend to buy a massive machine, that's just a cost. But the electricity you burn to physically run that machine day in and day out, that is the expense. You've got to keep that distinction crystal clear. So you might be wondering, where does the owner's skin in the game actually fit into all this? Well, that is your capital. It represents the owner's investment and their ultimate claim on the business. Now, remember this, and this is huge. When you see a scenario talking about an owner's investment, absolutely do not classify it as a liability. A liability is an obligation owed to outsiders. Capital is what the business technically owes back to the owner themselves. It's a subtle distinction, but trust me, they love testing it.
Okay, and what do we get when we subtract all those everyday expenses from our operational revenue? We get profit. Profit is simply your revenue minus your expenses. It's really your main indicator of performance. It shows your actual earnings after all the costs of earning that revenue have been completely deducted. Moving on to level 2, the core equation, smashing the terms together. Since we've got our vocabulary absolutely locked in, let's smash those terms together to reveal the core formula of all accounting. Right here, this is the accounting equation. It's basically the absolute law of gravity in BT. Assets equal capital plus liabilities. Think about the core logic for a second. Your business has resources, which are your assets. But those resources didn't just magically appear out of thin air, right? They had to be funded by someone. They're either funded by the owner, which gives us capital, or they're funded by outsiders, which gives us our liabilities. You might also see it flipped around a bit. Assets minus liabilities equals capital. Same exact logic. Let's step right into the examiner's minefield. Literally every single transaction impacts this equation, and the scales must always stay perfectly balanced. So picture this. You take out a bank loan, your cash asset goes up, great, but your liability, the loan you now owe, must also go up to match it. Or say an owner invests their own personal cash into the business. Your cash asset goes up, but so does your capital. See? The balance is never, ever broken. The absolute most common mistake I see students make is updating just one side of the equation and completely forgetting the other. It happens all the time. If an asset increases, you absolutely must look for an increase in either a liability or capital, or maybe a corresponding decrease in a different asset. You've got to vigorously check that the balance is maintained in every single scenario. Honestly, keep this one-line summary echoing in your head during the exam. Assets always equal funding sources. It's that simple.
If you remember this foundational logic, you're going to effortlessly navigate any transaction impact question the examiner throws your way. Okay, level 3, the final product, decoding financial statements. Let's take all these building blocks we've discussed and see how they actually form the 2 primary financial statements you need to know for BT. Notice the highly tested distinction between your 2 primary statements here. It all really comes down to timing. The statement of financial position, or the balance sheet, is literally a photograph. It's a snapshot of your assets, liabilities, and capital at one single frozen point in time. The income statement, on the other hand, that's more like a video. It measures your revenue, expenses, and your ultimate profit over an entire period, like a whole month, a quarter, or a year. So if a scenario asks you which statement shows position, the answer is definitively the balance sheet. If it asks which statement shows performance, the answer is the income statement. The crucial takeaway to lock into your brain is just this simple trigger. Position equals balance sheet, and performance equals income statement. Don't overthink it. All right, here we go. Boss level, the cash versus profit trap. You've made it to the final boss level of this explainer, and we're facing the single most lethal trap in the entire BT financial statement syllabus. Let's do this. The examiner loves to present this scenario. A company's profit is absolutely soaring. It looks amazing, but their bank account is completely empty. And then they'll ask you to explain why. Seriously, think about it. How can a business earn a massive profit but have absolutely zero cash to show for it? Well, this is the deadly credit sale trap. Imagine you land this massive contract and you make a huge sale on credit today. Now, because of accounting rules, the accruals and matching concepts, you are strictly dictated to record that revenue immediately. So, boom, your profit shoots straight up on paper. Looks great. But in reality, your client hasn't actually paid the invoice yet. They still owe you. That delay is what we call a timing difference. And man, it creates a massive illusion of wealth. Please never, ever assume profit equals cash. Profit is just an accounting concept. It's this somewhat artificial figure calculating using rules and accruals. Cash, though? Cash is cold, hard reality. It's the physical, undeniable truth of your bank balance. A super common mistake students make is just assuming profit and cash move in perfect sync. They absolutely do not. And ignoring this massive disconnect is easily the fastest way to lose marks. Look, if you take absolutely nothing else away from this explainer today, let it be this. Profit is accounting. Cash is reality. Say it with me. When a scenario describes a business that looks incredibly healthy on paper but somehow can't pay its bills, immediately, and I mean immediately, start looking for credit sales and timing differences. All right, you now know the traps. You're armed with the exact logic needed to totally dismantle the examiner's tricks. You know the vocabulary, you understand the balancing act of the equation, you've got the distinct timings of the statements down, and you see right through the deadly cash versus profit trap. But here's the thing, knowing the traps and surviving them under intense exam pressure, those are 2 very different things. When you finally sit down for that exam, will you see the matrix, or are you going to fall for the illusions? Time to dive into those practice questions and prove it. You've got this. Welcome back to the explainer, everyone. I am absolutely pumped you're here today because we're basically holding a high-stakes tactical briefing. Seriously, if you're prepping for that ACCA BT 1 exam, you're going to want to consider this your ultimate survival guide. We're cutting out all the fluff today, and we're strictly covering one of the absolute most heavily tested and frankly most frequently misunderstood concepts in the whole syllabus. Cash versus profit. We're going to lock down the exact logic you need to dodge those traps the examiner has waiting for you. So, get ready, get focused, and let's conquer this thing. All right, profit on one side, cash on the other. Let's just immediately shatter the ultimate accounting myth right out of the gate. Profit and cash, they are absolutely not the same thing, period. End of story. So many candidates walk into that exam room totally believing that if a business is showing this massive profit, its pockets must just be bursting with cash. And honestly, that assumption right there, that's exactly how you fail the question. We are drawing a thick, uncrossable line between these 2 concepts today. Section 1, Accounting versus Reality. So think of profit as merely an accounting concept. It's really just an abstract number governed by these rules called accruals and matching. It's kind of like a purely theoretical calculation just sitting on a piece of paper. The matching principle basically dictates that we record revenue when it's earned, and then we match the expenses to it. To put that super simply, if you deliver a product to a client today, you record the profit today. And that's regardless of whether a single actual coin has changed hands. You've earned the right to that money, so the accounting system says, hey, great job, you made a profit. But listen, that profit is completely detached from the physical money in your pocket.
Now cash is the exact opposite. We are talking about actual money. It's the hard currency sitting in the bank, the physical notes in the register. It's blunt, it's simple, and it is reality. Imagine, say, a highly profitable tech startup. On paper, they're making millions, right? Because they've signed these massive contracts and delivered their software. But if their clients haven't actually paid them yet, they literally have zero cash. And what happens then? They go bankrupt. Because you can't pay your employees with profit. You can't pay your server and electricity bills with an accounting concept. You have to pay them with cash. If you can firmly separate this concept of profit from the hard reality of cash in your head right now, you are already halfway to acing this whole section of the BT1 paper.
Moving on to Section 2, the credit sale trap.
Okay, I want to pose this exact exam scenario directly to you exactly how you're going to see it on test day. How can a business magically show that it has earned a profit, but its bank balance hasn't gone up by a single penny? It totally sounds like a riddle, right? I mean, profit is earned, but there is absolutely no cash to show for it. How in the world does this happen?
A credit sale. Boom. That is the ultimate trap, and it's your golden answer. When you sell goods on credit, you are handing over the product to the customer today, but you're agreeing that they'll pay you in, let's say, 30 days. That timing, it's absolutely crucial. You've made the sale today, sure, but you are not going to see that money for another 30 days. Let's break down exactly how this disconnect builds. Step 1, the sale is made on credit. Now, because of those accounting concepts we just talked about, accruals and matching, the exact second that sale is finalized, Step 2 triggers. Your profit immediately increases on the income statement. Technically, you've earned it. But look at Step 3. Cash is not received. You literally just have a promise from the customer to pay you later, a receivable. This right here, this creates a massive gaping disconnect between your accounting records and physical reality. Your profit is soaring, but your cash is totally stagnant. Section 3, beating the exam.
Listen closely. You must never make these two common exam mistakes. Number 1, assuming profit equals cash. If you read a scenario and subconsciously make that link in your head, you're going to choose the wrong multiple choice option for sure. And number 2, ignoring timing differences. The entire credit sale trap relies 100% on a timing difference. You know, that gap between when the transaction actually happens and when the cash physically moves. Ignoring that timing difference is exactly how they get you to fail the question. So drill this direct scenario to answer mapping into your head right now. Treat this as an absolute, non-negotiable survival rule for the BT1 paper. If the exam scenario reads profit earned but no cash, your brain should immediately lock onto credit sale in the options. That is the exact mechanism separating the accounting figure from the physical money. Seriously, lock this into your memory right now. I honestly just want to drop the mic with this golden one-line summary straight out of your BT1 notes. Profit is accounting, cash is reality. You need to treat this as a strict, unforgettable mantra. Take a breath and just let that sink in for a second. Profit is accounting, cash is reality. When you're sitting in that exam hall and you're stressed and second-guessing yourself, repeat this line in your head. Profit is just the accounting story, cash is the hard, cold reality. So I'm going to leave you with this final challenge. When the examiner sets the trap, and trust me, they absolutely will, are you going to let a simple timing difference cost you your score? Of course not. You are now totally immune to the cash versus profit illusion. But, you know, it does beg a bigger question. If profit can be this deceptive, what other numbers on a company's financial statements are really just theoretical illusions waiting to trap you? Keep that in mind and go conquer that BT1 exam.
All right, welcome to this explainer. Today, we are diving straight into the ACCA Business and Technology Notes to untangle what I like to call a fundamental illusion. It's one that trips up so many people: cash versus profit. Now, I know it sounds like a totally simple distinction, right? But the disconnect between these two concepts is absolutely massive. And let me tell you, mastering it, it'll completely change how you view a business's true health. So let's just get right into it.
Okay, think about this for a second. If your business makes a massive profit, why on earth might your bank account be completely empty? Seriously, it's a terrifying scenario for any business owner. But the crazy thing is, it happens all the time. You look at your income statement, you see this incredible profit margin, you're popping champagne, and then you check your bank balance to actually pay your suppliers, and there's nothing there. Literally zero. How's that even mathematically possible? Well, this high-voltage question highlights a massive disconnect that we're going to decode today.
And that brings us to the absolute golden rule of this explainer. Profit does not equal cash. We literally cannot ever conflate these two things. Honestly, forgetting this incredibly simple rule is exactly how the examiner will try to trick you. They'll lay out this beautiful, perfect scenario where a company is just booming, and then bam, they slip in a sneaky question about cash flow, just to see if you've fallen asleep at the wheel. So remember, profit absolutely does not equal cash.
When we put these two concepts head to head, it is just fascinating. On one side, we've got profit. This is basically a theoretical accounting concept, constructed on paper using a very specific set of rules. But on the other side, we have cash. Cash is hard physical reality. It's the actual money you can hold in your hand or physically see in your bank portal. One is literally just a theory of performance, and the other is the tangible lifeblood of your business. Let's break down exactly why they're so fundamentally different.
Let's deconstruct profit first. Profit is an accounting concept based entirely on the rules of accruals and matching. So what does that actually mean? Well, the matching principle dictates that we record income when it's earned, and then we match the expenses incurred to generate that income in the exact same period. And we do this totally regardless of when the money actually changes hands. Profit is simply a mathematical indicator of performance over a given period of time. It's built by accountants for accountants following these strict accrual rules.
Now, in stark contrast, cash is the hard reality of actual money. There are absolutely no theoretical rules here. No matching, no accruals. It is a binary state. The money is either in your bank account or it isn't. You cannot pay your employees with an accounting concept. You can't pay your electricity bill with the matching principle. You need actual hard cash. And this brilliantly illustrates why a business can be highly profitable on paper, yet completely bankrupt in reality if they just run out of cash.
So how does all this theory actually play out in practice? Well, the absolute best way to see how these concepts completely diverge in real time is by walking through a totally standard business transaction, the credit sale. A credit sale is when you sell a product or a service to a customer today, but you agree to let them pay you for it later. It's standard business practice, sure, but it creates this immediate accounting illusion. Let's map it out.
Okay, on day one, you make a massive credit sale. Instantly, under that accruals concept we talked about, your revenue goes up, meaning your profit spikes that exact same day. Your income statement? It looks amazing. But fast forward to month 2 when the cash is finally received. For an entire month, sometimes even longer, you've had a massive profit recorded, but absolutely zero cash from that sale to actually show for it. The core disconnect is right there in the timing. The profit is immediate, the cash is severely delayed.
So when we're prepping for the exam, there are two massive mistakes you've got to avoid. Mistake number 1, assuming profit equals cash. I know we've hammered this home, but under exam pressure, it's so easy to slip up. Just don't do it. Mistake number 2, ignoring timing differences. That timeline we literally just walked through, that's a timing difference. The profit was recognized on day 1, but the cash didn't show up until month 2. If you ignore that gap between when a transaction happens and when the cash actually settles, you are going to fall right into a trap.
And speaking of traps, here is a classic scenario you will likely face, straight from the source notes. The examiner will state something like, a business has profit earned but no cash, and then they'll ask you, what happened? They want to see if you can identify the exact real-world transaction that causes this divergence. So are you ready to crack that code? The winning answer, the key to unlocking that question, is the credit sale. When you see the phrase profit earned but no cash, your brain should immediately lock onto credit sale. As we just explored, it flawlessly explains this timing difference scenario. You did the work, you earned the revenue, your profit went up, but because it was on credit, the cash just hasn't arrived yet. Boom. You've identified the dynamic, solved the puzzle, and secured those easy points. I want to leave you with a really fantastic summary from the ACCA notes that basically distills everything we've talked about today. Profit is accounting, cash is reality. Take this mantra straight into your exam hall with you. Seriously, when you get a tricky scenario about business performance, just repeat this in your head. Profit is a set of rules, but cash is what actually keeps the lights on. So, I'll leave you with this final kind of provocative thought. Next time you look at a highly profitable company, whether that's in an exam scenario or just out there in the real world, will you fall for the accounting illusion or will you demand to see the actual cash?
Try to hardwire this concept into your brains, because once you understand the mechanics behind this illusion, you really unlock a much deeper understanding of business. Keep this focus, take this knowledge, and go absolutely conquer the rest of your accounting revision.
All right, welcome back, everyone. Today, in this explainer, we are tackling an absolutely critical topic from your Business and Technology, or BT syllabus. I need you focused, and I need you energized right now, because today, we're going to master centralization versus decentralization. We are going straight into the examiner's mind to see exactly how they test this stuff, and more importantly, how you are going to secure every single mark available. Let's get right into it.
So here is a massive question to kick things off. How do well-prepared students, the ones who know the theory, who've done all the reading, how do they lose easy marks on Test A? Honestly, you probably know the feeling. You sit down, you see the exam, and you've got all these massive, intimidating scenarios going on. Then you look at the requirements and you just think, wow, okay, that is a lot of information. Where do I even begin? Because under that intense exam pressure, simple definitions suddenly start to blur together.
I say this to my students all the time. Just imagine that in a few months' time, and look, I really hope this doesn't happen to you, but imagine you end up with 48 or 49 marks. The absolute agony of landing right there. You'd be so incredibly frustrated, right? Because if you had just nailed one more question, just remembered one more basic definition, you would have gotten over the line and passed. Well, that is not going to be you. We are putting in the effort right now to make sure you grab these specific easy marks.
Section 1, the head-to-head matchup, centralization versus decentralization.
Okay, let's start with centralization. I want you to lock this exact definition into your mind right now. Centralization is all about decision-making at the top level. That's literally it. The power, the control, all the big strategic choices, they are held tightly by top management. So think of the CEO or the board of directors sitting at the very top of the hierarchy, dictating the moves for the entire organization. There is absolutely no sharing of the steering wheel here.
Now flip that completely upside down and we have decentralization. The definition you need to hardwire here is decision-making spread across levels. Notice that keyword, spread. Top management takes that power and pushes it down the chain of command. They empower various managers at completely different tiers of the business to make their own calls. So in this case, the steering wheel is essentially shared with the people who are closer to the ground.
Let's look at how these two structures actually perform out there in the real world, and of course, how they're going to be tested. Think of this like the tail of the tape. First up, control. Centralized is strictly top level. Decentralized is distributed. Next, speed. Now, the notes explicitly tell us that centralized is faster, while decentralized is slower. Why is that? Well, because when one person or a tiny group at the top makes a sweeping decision, it's just an immediate mandate. Done. But when decision-making is distributed, coordinating all those moving parts and waiting for various levels to decide can actually slow down the whole corporate machine. But wait, look at flexibility. Centralized has very low flexibility. A rigid top-down rule just doesn't adapt well to local, on-the-ground problems. Decentralized, however, extremely high flexibility. If a local manager spots a sudden change in their specific market, they have the power to pivot immediately without begging for permission from headquarters.
Section 2, the exam hacker playbook, dodging examiner traps.
All right, knowing the theory is one thing, but knowing how the examiner uses that theory to trap you, that is what separates a pass from a fail. We are going to hardwire your brain right now to spot these tricks. So here's your first mental flashcard. When you're reading a long, messy scenario in the exam, and you see a sentence that effectively says, top management decides everything, or maybe all approvals must come from the board. Boom. Stop reading right there. The answer is centralized. You really don't need to overthink it. Grab the mark and just move on.
And here is your second flashcard. If the scenario tells you managers at different levels decide, or regional directors are given autonomy to set their own budgets, what is the trigger there? It's different levels. The absolute second you see that power has been pushed down and away from the top, your brain needs to instantly shout, decentralized.
Now, I need you to listen to me very carefully on this next point, because this right here is where good students just bleed marks. The absolute most common mistake in the exam hall is confusing delegation with decentralization. Guys, they are not the same thing. Delegation is just a manager giving a specific task to a subordinate. That's it. Decentralization, on the other hand, is a formal structural spread of decision-making power across the entire organization.
So if a manager asks an assistant to go write a report, yeah, that's delegation. It does not mean the whole company is suddenly decentralized. Please, do not fall for that trap.
And this brilliantly illustrates exactly what true decentralization looks like in a practical exam scenario. Think about a setup where branch managers take decisions. This isn't just one manager delegating a single random task. This is a systemic feature. The role of the branch manager inherently includes the power to make choices for their branch. When the structure itself empowers those lower levels, that, my friends, is your textbook decentralized structure.
Section 3. The ultimate cheat code.
Okay, we are at the final hurdle. We've covered the definitions, we've gone through the characteristics, and we've exposed the examiner's favorite traps. Now I want to give you the single biggest takeaway you absolutely must memorize before you walk into that exam hall. Here is your one-line summary. Say it with me, write it down, lock it in. Central equals top, decentral equals spread. That is your ultimate weapon to cut through all the noise of a chaotic exam scenario. If they are talking about the top, it's central. If they're talking about the spread, it's decentral. It really is that simple if you just keep your focus.
So, I'm going to leave you with this final challenge. When you are sitting in that exam hall and you face a totally chaotic real-world business scenario full of distractors, which control structure are you going to spot first? Are you going to see the power at the top, or are you going to see the power spread out? Remember the cheat code, dodge that delegation trap, and go secure your marks. You've totally got this. Thanks for joining me for this explainer, and I will see you in the next one. Keep practicing.
All right, let's tackle a huge topic for your BT exam, corporate governance. You have got to know this.
So, what stops a company's leaders from just doing whatever they want? It all comes down to one system.
And that system is called corporate governance. It's the rule book for how a company is directed and controlled.
Its whole job is to make sure management behaves and that everyone with a stake is protected. Okay, so how does this actually work? Well, it all starts with the shareholders, the owners. They can't run things day to day, so they hire a board of directors to keep an eye on things for them. The board then tells the management team what to do, and they're the ones actually running the show. This word right here, oversight. If you see that in your exam, your brain should scream governance.
And accountability? It just means management has to answer for what they do, good or bad.
Then there's transparency. It means no secrets. Key information has to be open and easy to find.
Now, here's a huge exam trap. Governance is not about running the company, it's about watching them run it.
You're definitely going to see stuff like this on your exam. See how every one of them points to governance? Seriously, if you remember just one thing, make it this. Governance equals oversight of management. That's it.
But so what? If it's just about watching people, how does that actually help a company succeed?
Welcome to The Explainer. We're tackling a topic that's absolutely vital for your business and technology exam.
So what is it? It's corporate governance. Seriously, this can separate a pass from a fail.
This is the textbook definition. It's all about how a company is directed and controlled from the top.
But if you remember just one thing, make it this. Governance equals oversight of management. And this is a super common mistake. Governance is oversight, not actually doing the daily work. So let's break down how this system is structured. You'll definitely want to know this. It's a pretty clear chain of command. Shareholders appoint the board, and the board oversees management. Simple. But why? Why do we even need all these layers? Well, it all comes down to one central problem. Really, it's there to protect stakeholders, create accountability, and make sure management is acting properly. So, what happens when managers don't act in the owner's best interests? This leads us right to the agency problem. This is a classic conflict of interest that good governance is built to solve. It's absolutely key.
The logic is simple, right? The owners don't control the company day to day. The managers do.
And here's the exam-friendly version. You see this conflict, your brain should immediately think agency problem.
Okay, enough theory. How do you turn all this knowledge into actual exam marks? Let's do it. If you spot these words in a scenario, boom, your answer needs to be about governance. Now, examiners love to lay traps with specific scenarios, so let's look at how to spot them.
These are just classic signals. You see the scenario, you link it directly to a governance answer.
And finally, let's talk about the mistakes that cost students marks every single year. Just being aware of these is half the battle. Always, always ask, is this an oversight issue? And that's a great final thought. Is it the system that fails, or is it the people in it? Welcome to The Explainer. Today, we're diving straight into a totally fundamental concept from your ACCA Business and Technology syllabus. We are strictly breaking down two little words that literally trip up countless students every single exam session. Let's get right into it.
So, are cost and expense the exact same thing? Look, in everyday conversation, you and I use these words interchangeably all the time, right? You might say, man, what's the cost of that new phone? Or wow, that subscription is a huge monthly expense. It feels like the exact same concept, just money leaving your pocket. But listen up, because here is the ultimate rookie mistake in ACCA, treating these everyday financial words as synonyms on your exam paper. Because in the strict world of accounting, they are absolutely not the same thing. And trust me, the examiner knows you might naturally think they are.
Okay, to really understand the difference, here is your golden definition for cost. A cost is the amount spent to acquire something. Now, I want you to put heavy emphasis on that word acquire. You need to separate it completely from your everyday language. When a business actually parts with its cash to bring a resource in, that initial outlay is a cost. You are securing something for future benefit. You haven't consumed it yet. You haven't, burnt through it to make a sale. You've simply spent an amount to acquire it. Make sense?
But here is where the whole concept pivots. An expense is a cost used in operations. Focus right on that word used. As your BT1 notes clearly outline, an expense is a cost incurred to generate revenue. It's basically the cost of actually running the business. So think about it. You had that initial cost when you acquired something, right? But once your business actually starts operating, once the gears start turning and you start consuming those resources to earn your income, well, that cost evolves. It completely transforms. It is actively used.
So the absolutely crucial point is this one-line summary. Cost becomes expense when used. Let me say that again. Cost becomes expense when used. This is literally a golden mantra from your syllabus. I want you to permanently cement this in your brain right now. You see, a cost doesn't just disappear. It just sits there as an acquired resource until it is consumed by the business. But the very second it's consumed, the exact second it's used up to generate revenue, boom, it graduates into an expense. And honestly, this brilliantly illustrates the entire life cycle of money leaving your business.
Let's ground this in reality so your brain really logs the practical difference here. Take a look at this side-by-side comparison straight from your ACC examples. Over on the left, we've got buy machine equals cost. When you buy a piece of heavy machinery, you are acquiring an asset. You are spending a specific amount to acquire something that's going to provide future economic benefit. That, my friends, is a cost. But then look over on the right. Use electricity equals expense. I mean, you don't acquire a giant stockpile of electricity to just sit in a warehouse somewhere, right? No, you use it. You consume power to keep the lights on, to run that heavy machinery, and to operate the business day to day. Consuming that power, actually using it in operations, well, that is an expense.
All right, everyone, high alert right here. We are shifting into pure exam survival mode. This right here is the ultimate exam trap. The examiner absolutely loves to test if you really understand this distinction or if you're kind of just guessing. So in a scenario question, if you see the phrase used in business or cost of running the business, do not fall for the trick. Do not select cost. The absolute instant or resources described as used or consumed for daily operations, your brain needs to flash bright red. Remember your golden mantra and you must select expense. The examiner is testing you on exactly how that cost has evolved.
And that brings us to a final thought for you to chew on. The next time you see money leaving the bank, whether you're working through a tricky practice question or you're out there in the real world, I really want you to ask yourself this. Are you acquiring a cost or are you using an expense? Are you bringing a brand new resource in or are you consuming a resource to keep the business running and actually generate revenue? Keep that golden rule front and center, apply it rigorously to every single scenario you read, and I promise you, you're going to nail these questions every single time. Thanks so much for joining me on this explainer. Keep up the fantastic focused learning, and I'll catch you next time.
Right. Ever wondered what really separates a successful business from one that's just constantly putting out fires and, losing money? Well, a lot of the time, it's something you can't even see. It's called internal control, and today, we're going to pull back that curtain.
Okay, so let's just kick things off with a little thought experiment. I want you to picture a business with absolutely no rules, no oversight, nobody double-checking anything. It sounds like pure chaos, doesn't it? Well, that's because it is. It's a total recipe for disaster.
And look, this isn't just some textbook theory. When you don't have controls, a business starts to leak. It leaks cash, it leaks efficiency, and maybe worse of all, it starts to leak the trust of its customers and investors.
I mean, just look at this slide. Your cash can literally just vanish. The financial records become a complete mess. You have no idea if you're actually making a profit. Fraud becomes almost a certainty, and your day-to-day operations just grind to a halt. So the big question is, how on earth do you fix this?
Well, you fix it with a system, a thought-out, deliberate process that management puts in place to direct and, well, control the business. This right here is what we mean by internal control. It's the answer to all that chaos.
Now, what's really interesting here is the official definition from the ACCA notes. You'll notice it kind of has two jobs, right? It's not just about stopping the bad stuff like errors and fraud. It's also about making sure the good stuff happens, making sure the business runs smoothly and efficiently.
If you really want to boil it all down, it comes down to these three powerful words. They are the absolute heart of internal control. First, you've got to safeguard your assets. We're talking cash, inventory, the whole lot. Second, you prevent errors before they even happen. And third, if something does slip through, you detect it as quickly as possible.
So that leads us perfectly to the two main lines of defense you're going to find in any good control system. Now, listen up, because this is a classic exam topic, and people get mixed up all the time. But it's simple, really. It all just comes down to timing.
And this slide just nails the difference. Think about it like this. Preventative controls are like the lock on your front door. They're there to stop trouble from ever getting inside. Requiring a manager's signature before a big payment goes out, that's a classic preventative control. On the other hand, detective controls are like your security camera. They don't stop the break-in, but boy, do they show you what happened afterwards. A bank reconciliation at the end of the month that finds a mistake, that's a detective control.
All right, now for the big one. This is probably the single most important, most powerful, and most tested preventative control there is. It's called segregation of duties. And honestly, the concept is just genius in its simplicity.
Let's just walk through this real-world example. It makes it so much clearer. The whole idea is incredibly powerful. No single person should ever control the transaction from start to finish. So, one person requests the laptop. A totally different manager has to approve it. A third person, someone in finance, makes the payment. And then a fourth person comes in and checks the bank statement. See how that works? By splitting up those key jobs, you make it way harder for one person to commit fraud or make a big mistake that goes unnoticed.
But here's the thing, and it's a huge thing. You can have all the rules and all the segregated duties in the world, but they are completely useless without the right foundation. And that foundation is what we call the control environment. Really, it just boils down to the company's whole attitude towards control.
And this slide just says it all, doesn't it? It's all about the tone at the top. If the senior managers are strict, disciplined, and they take this stuff seriously, that attitude filters all the way down, and you get a strong control environment. But if they're careless, if they've got a lax attitude, the entire system is fundamentally weak, and it doesn't matter how many rules you have written down in some dusty manual.
So, look, if you remember just one thing from this entire explainer, please make it this. Preventative is before the event, detective is after the event. That simple little line cuts through all the complexity, and it's the absolute key to understanding how all this works.
So, the final thought I want to leave you with is this. Have a look at your own workplace, or any company you know, really. Are their systems focused on prevention, on locking the door before trouble even starts, or is everyone just running around cleaning up messes and checking the security footage after the damage is already done? The answer to that question will tell you everything you need to know about the strength of their internal controls.
Welcome to this explainer. Look, if you're gearing up for the ACCA Business and Technology exam, you already know the absolute frustration of throwing away marks on basic, fundamental questions. It hurts, right? Well, today, we're hacking ACCA BT together to master the absolute core of accounting, assets and liabilities. We're going to see exactly how to bypass those sneaky exam traps and lock in those easy marks.
So, want to stop losing easy exam marks? Honestly, the truth is, trying to get through the ACCA Business and Technology exam without mastering these foundational concepts, it's basically an uphill battle. You just can't do it. But the second we lock these down, we immediately take back control of your score. Building this rock-solid foundation means the rest of your studying is going to become exponentially easier.
Now, these basics are very frequent foundation on the exam. Master these, and you're literally guaranteeing yourself exam success. I'm not kidding. The examiner absolutely loves to set traps on basic accounting terms. It's almost like it's a personal hobby of theirs. They'll tweak the wording just a tiny bit to make you second-guess yourself. But today, we're learning exactly how to hack them and to code those traps so you never, ever fall for them again. All right, Section 1.
assets, your future benefits. So, what exactly is an asset? Let's look at the formal definition. An asset is a resource owned by a business that provides future economic benefit. Now, what is absolutely crucial here are those last three words, future economic benefit. An asset isn't just, random office clutter or a fancy plant on your desk. It's something useful that actively works to bring in cash later. Think of it as a resource that practically has a future paycheck attached to it.
Okay, let's look at what we like to call the asset arsenal. You need to memorize these instantly. We're talking about cash, machinery, inventory, and debtors. Now, cash, machinery, and inventory make immediate sense, right? They're physical things you can use or sell. But debtors? Well, that's simply money owed to you by your customers. Because they owe you, it means future cash is coming your way down the line, making it a highly, highly valuable asset.
Moving on to Section 2, Dodging Asset Exam Traps.
The examiner is actively trying to trick you with specific wording, so here's exactly how to map their scenario to the correct answer. If a question mentions a future benefit, boom, the answer is an asset. If it says resource controlled by the business or helps generate revenue, don't even overthink it. It's an asset. Spotting these exact trigger phrases is your ultimate shortcut. Listen, they might bury these words in some massive long-winded story about a manufacturing plant, but your job is to cut through all that noise and just spot the triggers.
It all really boils down to this one golden rule. Asset equals future benefit. When you're sitting there in the exam hall, stressed out, pressed for time, seeing the words future benefit needs to be an automatic reflex for you to select asset. Make this equation an absolute rule in your mind. Repeat it right now until it becomes pure instant. Asset equals future benefit.
Now, to really lock this in, let's create a stark contrast. On one side, we have the future economic benefit we just talked about. On the exact opposite side, we find a future obligation. One brings cash in, the other forces a payout out. Recognizing this kind of push and pull dynamic is how you truly master the language of business.
That brings us to Section 3, Liabilities, Future Obligations. So, the flip side of the coin. A liability is, quite simply, an obligation that the business must pay in the future. See that word obligation? That represents a strict, unavoidable responsibility. It means an inevitable outflow of cash or resources is on the horizon for the business. You owe something to someone else, and eventually, well, the piper must be paid.
Let's run through our liability arsenal. These are classic examples that show up constantly on the BT exam. A loan from a bank. Creditors, the suppliers you owe money to because you bought inventory on credit. And of course, bills payable. Whenever these terms pop up, you are looking at an obligation. You're looking at a liability. Keeping these specific examples fresh in your head is going to save you so much precious time on test day.
Section 4, Dodging Liability Exam Traps.
Let's pivot back to those examiner mind games. Just like with assets, we can easily recognize the liability triggers to guarantee you score the point. If a scenario describes a payment obligation or an amount owed to others, your answer is liability. Again, they might dress it up in a giant paragraph about a company ordering specialized supplies on 30-day credit terms. But if it boils down to an amount owed, you know exactly what to do. Strip away the story, find the core obligation.
Let's hammer home our second golden rule. Liability equals future obligation. I want you to lock this into your memory right now. Asset equals future benefit. Liability equals future obligation. By simplifying these concepts into core truths, the examiner's tricks suddenly lose absolutely all their power. All those complex scenarios just melt away, leaving you with simple, actionable definitions.
Section 5, The Final Sprint.
Okay, here is your final, no-nonsense procedure to hack these questions in under 10 seconds flat on exam day. Step 1. You spot future benefit or resource controlled. You immediately choose asset. Step 2. You spot payment obligation or amount owed. You choose liability. That's it. Spot the trigger, lock in the answer, and bank the points. It is a systematic, totally stress-free way to approach what used to be really confusing questions.
So, are you ready to think like an examiner and pass with confidence? By applying these rules, you are taking absolute control of your exam prep, and you're going to stop losing those easy marks on basic terminology. Thank you so much for joining me on this explainer. But this leaves a pretty fascinating question. If assets and liabilities are just the clear-cut foundation of the balance sheet, what kind of hidden complexities and traps are lurking within equity and revenue? Well, we're going to have to uncover that next time.
All right, welcome. Today, we're going to break down one of the most fundamental concepts in your ACCA Business and Technology syllabus, internal versus external risk. Now, getting this right is an absolute game changer for your exam, so let's jump right in. So, what is it that keeps business leaders up at night? Is it a brand new competitor that just popped up, a massive system failure, or maybe a sudden change in government rules? The list of threats is pretty much endless, but the very first step to managing any of them is always the same. You have to figure out where they're coming from. Okay, let's start with the official ACCA definition just to get us grounded. Risk is simply the possibility that some event will come along and affect a company's goals. Now, notice that word possibility. It's all about uncertainty. And yeah, sometimes that can mean good things like new opportunities, but for what we're talking about today, we're really focusing on the threats. To really nail this topic for your exam, you need to know the single most important way to categorize risk. And it all comes down to that one really simple question: where did it come from? And here it is, the fundamental divide. Every single risk you'll ever face can be put into one of two buckets. It's either coming from inside the business, or it's coming from the outside. Honestly, it really is that straightforward. So let's start with the inside jobs. We're talking about the risks that bubble up from within the company itself. So internal risks are really part of a company's daily life. They come from its own operations, its own people, its own systems. But the key thing to remember here is that these are the risks a company has the most control over. And that means they can be managed and sometimes even prevented entirely. Let's think about some real-world examples. An employee makes a really costly mistake. A critical computer system crashes right before a massive deadline. An employee commits fraud. Or maybe it's just that the company has weak internal controls that allow all of these things to happen in the first place. All of these, they're classic inside jobs. Now, a fantastic example of internal risk that you'll see a lot in your studies is something called the agency problem. This is what happens when managers, the agents, start making decisions that benefit them personally, maybe to get a bigger bonus, instead of acting in the best interests of the company's owners, who are, of course, the shareholders. So what's the bottom line here? It's simple. If it's happening inside the company's walls, or it's because of its own people and its own processes, it's an internal risk. All right, so we've looked inside the building, now let's step outside and look at the other side of the coin. Now we're talking about all those risks that come from the wider world, those outside forces that can completely knock a business off its course. External risks, they come from the world outside the company, the economy, the government, the marketplace. And here's the crucial difference. Unlike internal risks, a company has very little or even no control over these. It can really only try to anticipate them and then react as best it can. So what does this actually look like? Well, it could be the government suddenly dropping tough new regulations, or the whole economy sliding into a downturn. Maybe the central bank jacks up interest rates, which makes borrowing way more expensive. Or it could even be a powerful new competitor opening up shop right across the street. So the takeaway here is just as simple. If the risk is coming from outside the company and it's something they just can't control, you're looking at an external risk. So we've covered the theory, right? Internal is inside, external is outside. But why is making this distinction so incredibly important for your exam? Well, let's get practical. So why does this all matter so much? Because when you're in that exam and the pressure is on, it is so easy to misclassify a risk. And that's a simple little mistake that can end up costing you some really valuable marks. Take a look at this. This is a classic exam trap. You might see a scenario that says staff mistake, and your brain might immediately jump to the financial loss. But you have to ask yourself, where did it originate? It originates inside, so it's internal. Same thing with economic change. You might focus on the disruption, but the origin is external. Getting this classification right is always the first step to a fantastic answer. And look, if you remember absolutely nothing else from this explainer, please remember this simple, powerful summary, straight from the source material. Internal equals inside, external equals outside.
That is the ultimate takeaway for your revision. Burn it into your memory.
And that really brings us to our final thought. You can now spot the risk, you can classify it perfectly. But that leads to the next logical question for your studies, doesn't it? Once you've figured out where the risk comes from, how should the business actually respond to it? Well, that's a topic for another day. Thanks for watching.
Right, listen up because today we're moving fast and we're hitting hard. If you're studying for the ACCA Business and Technology exam, the BT1, you absolutely need to hear this. Okay, let's dive straight into this explainer because I'm going to guarantee that you secure those highly tested marks on a topic that literally catches thousands of students out every single sitting. I'm talking about leadership versus management. Get focused, get ready, let's go.
Now, I need you to be completely honest with yourself for a second. Are you losing easy exam marks? Are you throwing away free points just by blurring the lines between these two concepts when you're reading those incredibly dense exam scenarios? Because look, the examiner knows students mix these up, and they set traps specifically to catch you out. But not anymore.
Section 1. The ultimate exam face-off. Visionary versus executor.
Okay, here are the exact differences you need to memorize. Leadership, it's all about vision, inspiring people, driving change, and having a massive future focus. Contrast that immediately with management, which is all about execution, control, stability, and a present-day focus. Seriously, grab your notebook and write these dichotomies down right now. If the scenario is high-level and looking forward, boom, it's leadership. If it's grounded in present-day realities, just keeping the wheels turning, that's management. Do not mix them up.
Section 2. The visionary leader, setting the direction. What's really interesting here is the total precision of the academic definition. Check this out. Leadership is the ability to set direction and inspire people. I want you to punch those words into your memory right now. Direction, inspire. These are the core, undeniable markers of a leader in any ACCA scenario. If someone in your exam exhibit is pointing to the horizon and getting people absolutely fired up to march there, you're looking at leadership. So the crucial point here is driving change for the future. Whenever an exam scenario shows a character looking years down the road, actively shaking up the status quo, and bringing in totally new ideas, you must instantly recognize this as leadership. Because leaders don't accept how things are today, right? Their entire purpose is to change how things will be tomorrow.
Section 3. The practical manager, execution and control.
Listen to this definition, and I want you to literally deliver it with rigid, structured pacing in your own head. Management is the process of planning, organizing, and controlling work. Did you hear the difference there? Management is all about the process. It's about controlling the work. It's structural, it's highly methodical, and it's entirely focused on execution.
Let me warn you right now. If the exam exhibit shows someone maintaining stability today, someone keeping the ship steady, ensuring the budget's balance, and focusing strictly on today's tasks, they are executing management. They are not out there changing the world. They're just making sure the business doesn't fall apart before 5 p.m.
Okay, I'm going to slow down just slightly here because you absolutely need to hammer home this golden rule. Leadership inspires, management controls. Write that down immediately. Do it now. This is literally your ultimate exam cheat code. If you remember absolutely nothing else from this explainer, remember this one sentence because it cuts right through the noise of any confusing scenario.
Section 4. Exam keyword cheat sheet. Master the triggers.
We're going to actively train your brain right now. When you're reading a paragraph in the exam and you see the words vision or motivation, I want your hand to immediately hover over leadership. But the second you spot words like control or planning, you instantly lock in management. It's a simple trigger and response system. Vision equals leadership. Control equals management. Simple, brutal, and incredibly effective. Section 5. Securing your marks. Beat the examiner.
All right, here's a classic scenario trap the examiner absolutely loves to pull on you. A director sets up a new daily reporting system. Is this leadership or management? I'll give you 3 seconds to guess. 1, 2, 3. So, what did you choose? Did you fall for the title?
Here's the exam fix. The answer is strictly management. Why? Because you must focus on the action, not the title. Setting up a reporting system is a mechanism of control, and as we just learned, control equals management. It doesn't matter one bit that their title is director or CEO or whatever. Look at what they're actually doing in the scenario. Action over title, every single time. That is exactly how you beat the examiner. So how do you make this stick? Here's the highly practical, ultimate revision strategy you need to execute immediately after this explainer ends. Step 1. Attempt MCQs on the ACCA free practice platform with your timer on. Step 2. Deeply review your mistakes. Use a review template, find those concept gaps, and fix them. Step 3. Attempt a full mock without pausing. Remember, you learn significantly more from your mistakes than you do from just staring blankly at your notes.
Which brings me to my final vital question for you today. Are you going to just passively read the notes, or are you going to use this keyword strategy to completely control your exam results? The choice is entirely yours. Get fired up, grasp this material, and go smash those practice questions right now. You have the tools. Now go execute.
Okay, let's absolutely nail internal control for your BT exam. You ready? So, how do we turn this tricky theory into easy exam marks? Let's break it down. Right, first things first. Internal control is simply a system to stop or find errors and fraud.
But what's it really for? The examiner loves asking about its 4 main purposes, so listen up.
It's all about safeguarding assets, making sure records are accurate, preventing fraud, and boosting efficiency. Simple. Okay, now for the most important bit. This is where you'll really pick up marks. The 2 types. It's preventative versus detective. Just think, before an error happens versus finding it after it's happened.
So, preventative controls? They're like a big wall. Their job is to stop errors from happening. Like getting a manager's approval before a payment goes out, that's a classic preventative control. And detective controls, they're like a search party. The error's already occurred, now we gotta find it.
Think about a bank reconciliation. You're looking for mistakes from last month. That's detective work. Okay, let's talk about a crucial preventative control the examiner loves: segregation of duties.
You know the drill. One person records, another approves, and a third one reviews it. Simple split.
And why do we do this? Because if one person does it all, fraud becomes way too easy. So how does this all look in the exam? Let's get right into some typical questions. Seriously, learn these scenarios. Approval before payment is preventative. Checking records after is detective. Got it?
Look, if you remember just one thing from all this, make it this. Preventive equals before, detective equals after.
Now think about your own job. What's one control that could stop the most common error there? All right, guys, welcome to the Explainer. Today, we're decoding an absolutely crucial topic for your ACCA exams: public versus private companies. If you're gearing up for business and technology, or, even touching on corporate and business law, you know exactly why we're here. This topic is literally a cornerstone of the syllabus, and the examiner, well, they absolutely love to test your understanding of these specific corporate structures. So are you ready to crush this? Because this is a highly tested area, and we need to make sure you dodge every single trap the examiner sets for you. We're not just going to sit here and read facts today. No way. We are going to build a mental framework so incredibly solid that when you see a multiple choice question on this, you'll instantly know the answer before you've even finished reading the options. Let's dive right in. Section 1. Introducing public and private.
Okay, so the baseline dividing line here is beautifully simple. A public company, that just means its shares are traded publicly on a market. Basically, anyone can buy in. A private company, on the flip side, means its shares are kept totally locked down and are not publicly traded. That is the fundamental difference. It's all about the shares and exactly who can get their hands on them. The absolute second a company's shares are opened up to the general public to buy and sell on an exchange, boom, it crosses that threshold into being a public company.
Now, before we move on, listen up, because I want to give you a really quick cross-syllabus golden nugget here. If you're also looking at your corporate and business law notes, the LW exam, you absolutely must remember that a public limited company, a PLC, requires a minimum share capital of £50,000. That's a hard, non-negotiable legal requirement to operate as a public company. So just lock that number in your mind right now, £50,000 for a PLC.
Section 2. The big 3 differences. All right, so this right here is your holy grail for this topic. You absolutely must be able to perfectly contrast these 3 core features: share trading, the level of regulation, and the scope of ownership. So for a public company, share trading is public, regulation is high, and ownership is wide. For a private company, share trading is restricted, regulation is lower, and ownership is limited.
Literally every single scenario question you face on this topic is going to map straight back to one of these three core concepts. Let's unpack the public side first, okay? For public companies, remember that because ownership is really wide, meaning there's a massive, massive number of everyday shareholders, and those shares are actively traded publicly, the examiner expects you to know that regulation is incredibly high. And the crucial point here is the why. Why is regulation so high? Well, it's because the government and financial authorities, they need to protect all those everyday investors. High regulation is basically the necessary trade-off for getting access to all that public money.
Now, conversely, let's look at the private company profile. Private companies have restricted ownership, and their shares are simply not publicly traded. And because you don't have thousands of everyday people buying in, the regulation is noticeably lower, which honestly perfectly explains why founders or owners often choose to stay private. Think of massive, massive companies like ACCA or Mars. They deliberately stay private specifically to avoid that outside interference. By dealing with restricted ownership and lower regulation, the original owners get to retain so much more control over the direction of the business. Less outside money essentially equals less outside interference.
Section 3. Dodging the exam traps.
We are now entering the danger zone, guys. The examiner is definitely going to try to trick you here, so let's do a rapid-fire quiz. Question 1. If the exam scenario tells you that a company's shares are listed on a stock exchange, you need to instantly know the answer. Don't overthink the wording. Just look at that key phrase, listed on a stock exchange. What kind of company is it?
Boom, it's a public company. It really is that simple. The word listing literally equals public. If a share is listed, it just means it's sitting out there on a public market for anyone at all to buy. The examiner will absolutely use the word listed as a direct synonym for traded publicly. So do not let the vocabulary throw you off. Okay, next scenario. Let's see if you can catch this one. What if the text in the exam suddenly tells you share transfers are restricted? Again, zero in on the key word there, restricted. Where does that belong in our Big Three framework? Exactly. It's a private company because those shares are not freely moving around the market. If you literally have to go ask permission from the board of directors to sell your shares to someone else, well, that is a restriction. And restrictions mean the company is private. You guys are doing great. Let's keep this momentum going. So what are the actual pitfalls here? Well, according to your syllabus notes, the two most common mistakes students make are, number 1, completely confusing the concept of listing with just simple ownership, and number 2, totally ignoring the massive difference in regulatory burdens between the two. Listen, just because a company is huge and has a ton of owners doesn't automatically make it public. It is only public if it's listed. And remember, public companies carry a massive regulatory burden that private companies simply do not have. So please, whatever you do, do not ignore that regulation difference when you're reading an exam scenario. Let's actually ground this with a really specific example from the text. If you see an example in your exam paper, like a company listed on the National Stock Exchange or the NSE, that listing is your absolute dead giveaway. Listed on the NSE equals a public company. They might try to throw you off and give you a giant, rambling paragraph of backstory about the company's founders, but I promise you, if that one single sentence says, listed on the NSE, everything else is just noise. It's public.
Section 4. The ultimate memory trigger.
All right, let's cross the finish line with the absolute most important takeaway you need before you walk into that exam hall. Burn this one-line summary into your brain right now. Seriously, say it out loud with me if you have to. Public equals listed, private equals restricted. That right there is your ultimate cheat code for this entire section of the syllabus. Public equals listed, private equals restricted. If you filter every single exam question you get through that specific lens, you will literally never get a public versus private company question wrong again. Now that you have these core differences and exam traps completely locked down, how are you going to apply this to your next practice paper? The next time you look at your absolute favorite brand today, I want you to ask yourself, are they listed or are they restricted? And how does that corporate structure actually shape the products you buy from them? Take this framework, apply it to your revision, and start looking at the corporate world with a completely fresh perspective. Thanks so much for joining me on this explainer, and keep that focused energy up.
All right, hello and welcome. Have you ever been in that ACCA exam? You see a risk question, and that little bit of panic starts to set in? Well, you are in exactly the right place. We are going to walk through a super simple but really powerful framework that is just designed to get you marks. So let's dive right in.
So imagine this. You're there. The clock is ticking away. You read the scenario. A new, aggressive competitor is on the scene, threatening everything. The question asks you to recommend a response. So, what do you write? I mean, where do you even start with that?
You know, a lot of students might just freeze up, write something, well, kind of vague and generic. But that is not going to be you. No way. By the time we're done here, you are going to walk into that exam hall with the exact toolkit the examiner is hoping to see.
And here it is. This is your toolkit, the ARTA framework. It's a simple little acronym that gives you 4 crystal clear, professional responses for pretty much any risk scenario they can throw at you. Honestly, think of it as your secret weapon for a top-scoring answer. ARTA, avoid, reduce, transfer, accept. That's it, just 4 words. Your first job is to get this burned into your memory. Why? Because it instantly gives your answer a professional structure. It tells the examiner, yep, this person knows what they're talking about.
So let's break down each one of these responses. We're going to get into exactly what they mean, when you should use them, and of course, look at a classic example for each one.
Okay, first up, we've got avoid. Now, this one is the most extreme response you can have. It doesn't mean you make the risk a little smaller. It means you get rid of it completely by stopping whatever activity is causing it. You are literally just walking away from the risk. So, for example, let's say a company is thinking about a big project in a country that's, well, politically unstable. The avoid response is simply to cancel the project. No project, no risk. It really is that simple.
Next up is reduce. And honestly, this is probably the most common response you'll see. The company doesn't stop what it's doing. Nope. Instead, it puts controls in place to reduce either how likely the risk is to happen or how bad it'll be if it does.
A great example is the risk of employee fraud. You don't just stop hiring people, right? Instead, you reduce that risk with internal controls, like maybe you require 2 people to sign off on big payments, or you provide special training for your staff. The business continues, just in a safer way.
Okay, next we have transfer. Now this one's pretty clever. With this strategy, the risk is still out there, but you basically make it someone else's financial problem. You're not stopping the activity, and you're not even necessarily making it less likely to happen, but you're protecting your own wallet if it does.
The absolute classic example here is insurance. You're worried about your warehouse burning down? You buy insurance. If the fire happens, the insurance company pays for the damage. See? You've transferred the financial risk. Outsourcing a really complex IT function is another great one. You're transferring that operational headache to a specialist firm.
And finally, we have accept. Now this might sound a bit passive, like you're just giving up, but it's not. It's an active, strategic decision. It means you've looked at the risk, you've analyzed it, and you've decided that the cost of doing something about it is actually more than the risk itself.
A perfect example is the risk of, say, minor office supplies going missing. Is it really worth installing a huge, complex security system just to stop a few pens from disappearing? Probably not. The accept response is to just acknowledge it happens, and maybe you budget for a small amount of loss each year. You just accept it as a cost of doing business. Okay, so you know the 4 responses. Brilliant. Now let's talk about where students lose easy marks. The examiner absolutely loves to test the small differences between these terms, and if you're not paying close attention, it's so easy to fall right into the trap. And here it is, the #1 point of confusion for students: avoid versus reduce. The key difference is so simple. With avoid, the activity stops, full stop. With reduce, the activity continues, but you add new controls. One gets rid of the risk completely, the other just lessens it.
I really can't stress this enough. If the scenario says a company has canceled the project, that is avoid. If it says they've added more safety checks to a project, that is reduce. Getting this right is a guaranteed mark. It's a gift. Don't throw it away.
Think of this as your exam day cheat sheet. You gotta look for these keywords. Do you see the word insurance in the scenario? That's transfer. See a project stopped or canceled? That's avoid. New controls or training? That's reduce. And if they've looked at the risk and consciously decided to do nothing, that's accept. It really is that straightforward.
So let's pull all this together. When you see that risk question pop up on your exam paper, what is the one single thing you need to remember to structure your entire answer and just nail those marks? It's ARTA. Just remember your 4 options, start your answer by identifying the risk, and then just go through it. Evaluate each of these 4 options, avoid, reduce, transfer, accept, in the context of that scenario. This is your roadmap to a clear, logical, high-scoring answer. Look, you have the toolkit now. You have the framework. You know the definitions, you've seen the examples, and you know the common traps to look out for.
So go into that exam, apply ARTIA with confidence, and get the marks that you absolutely deserve. You've got this.
All right, let's talk about a huge internal control concept you absolutely need for your exam. So, what if one person could do it all? Raise an invoice, approve it, and then pay it. Yeah, big risk. To stop that from happening, businesses have a key principle. It's a game changer, really. It's called segregation of duties. Basically, different people handle different parts of one single job.
But why is this so critical? Well, it does two incredibly important things for a business.
First, it makes fraud way harder. And second, it helps catch honest mistakes early on. Okay, let's see what this actually looks like with a super simple, real-world example. So, person A records the transaction. Then, person B has to approve it. And finally, person C reviews it.
See? 3 different people, 3 separate tasks. That right there is a strong internal control.
Okay, now for the most important part, the big exam trap. You have to watch out for this.
If you ever see one person doing everything from start to finish, that's a weak internal control.
So the difference is clear, right? Strong controls separate tasks. Weak controls combine them in one person.
And that's your key takeaway. Spotting this lack of separation means you've found a weak control.
So think about it. Where else in a business is it absolutely critical that no single person holds all the keys?
Welcome to The Explainer. Look, if you're gearing up for your ACCA Business and Technology exam, you already know the drill. The syllabus is absolutely packed with specific terminology. And the examiner, well, they just love to test your precision. So today, we're launching a high-energy, rapid-fire exam battle plan covering sole traders and partnerships. We are going to build you an airtight mental framework so you can navigate these business structures with absolute, total confidence. Let's get into it.
Okay, picture this. It's a high-stakes scenario straight out of a classic exam paper. You're sitting in the hall, the clock is ticking down, and you read this exact sentence. 2 friends start a business. The question asks you to classify the structure. So what's your gut reaction? Is it a company or is it a partnership? I mean, it sounds like a totally casual everyday situation, right? But in the ACCA world, every single word is a clue. If you guessed company, ouch, you've actually just fallen right into a massive examiner trap.
Section 1. The sole trader.
Now, before we figure out what happens when 2 people team up, we really need to nail down what it looks like to fly solo. A sole trader is, well, exactly what it sounds like on the tin. It's a business owned entirely by one single person taking on the commercial world completely alone. No co-founders, no shareholders, 0 board of directors. Just one individual setting up shop. Think of your freelance graphic designers, local plumbers, or independent consultants. It is genuinely the simplest setup you're going to encounter in the syllabus. But hey, don't let that simplicity fool you for a second, because the examiner is definitely going to test you on the specific legal and financial quirks of this solitary setup.
So operating as a sole trader means you get absolute 100% control over the business. You're calling all the shots without having to ask anyone for permission. And the best part? You keep every penny of the profit. Sounds great, right? But there is a massive catch. You are also burdened with unlimited liability. This is absolutely crucial to understand, because you and the business are legally viewed as the exact same entity. If the business fails and owes money, your personal assets, we're talking your car, your house, your life savings, they're all entirely on the line to pay off those business debts.
Moving right along to Section 2, the partnership.
So what exactly happens to that legal and operational structure when you finally bring a co-founder into the mix? Let's look at how the dynamics fundamentally shift. This brings us to the partnership, which is strictly defined as a business owned by 2 or more people. Literally, the second a second person joins the ownership structure, boom, you are no longer a sole trader. You've officially formed a partnership. This is a highly tested definition because it's the most basic form of collective business ownership out there. The real game changer here is that you've now got shared ownership, shared profit, and, you guessed it, shared risk. You're no longer making decisions in a vacuum. Everything is a joint effort now. But I need you to pay really close attention to that last point. Unless the exam scenario explicitly states that it is a limited partnership, you still face unlimited liability. Yep, just like the sole trader, a standard partnership offers absolutely 0 protective legal wall between the business's debts and the partner's personal bank accounts.
Section 3. The head-to-head clash.
Let's actually put these 2 structures in the ring for a head-to-head clash. We need to see exactly how they compare across the 3 core exam pillars. You're going to want to practically tattoo this mental matrix on your brain for exam day. Think about it. Owners, it's 1 versus 2 or more. Profit, individual versus shared. And decision-making shifts directly from individual control to joint agreement. So if its scenario mentions a single person pocketing all the profits and making all the choices, bam, sole trader. The split second you see words like shared or joint, your brain needs to immediately switch tracks to a partnership.
Section 4, the liability trap.
Listen up, because we're looking at the single biggest trap where students just throw away easy marks. Both the sole trader and the standard partnership carry unlimited liability. That means there is zero, and I mean zero, legal separation between the owner's personal assets and the business. In the eyes of the law, the owner literally is the business. Remember earlier in your syllabus when you learned that a company is a separate legal entity with limited liability? Well, a sole trader and a standard partnership do not get that magic shield. If the business goes bankrupt, the owners go bankrupt. The examiner absolutely loves testing if you really grasp this distinction.
Section 5, exam traps and tricks.
All right, let's shift gears from passive learning to active test prep mode with a rapid-fire breakdown of the examiner's favorite tricks. Because let's be real, knowing the definitions is only half the battle. Knowing how the examiner is going to try to mess with you, that's what actually gets you a passing grade. They will constantly try to trick you into assuming these basic structures have limited liability, or they'll try to make you confuse a standard partnership with a separate legal company. In everyday life, sure, people use the word company to describe literally any business. But in your exam, company means a very specific, legally separate entity with shareholders. A partnership of two friends is absolutely not a company. Do not let everyday slang cost you your hard-earned marks.
Let's see how this builds into an actionable exam strategy. When you're reading a scenario, if you see the phrase single owner, your brain must immediately scream sole trader. But if you see profit shared or joint decision-making, you instantly lock in partnership. The examiner relies on these exact trigger words in the multiple choice options. If you train yourself to spot them on site, you're going to save yourself so much valuable time on the clock.
So, circling all the way back to that hook from the very beginning, when the exam scenario explicitly says, two friends start a business, the only correct answer is a partnership. It is definitely not a company because there's no mention whatsoever of a separate legal entity, shareholders, or limited liability. It is just two people sharing the risk and the reward, which means it perfectly, neatly fits the definition of a partnership.
To wrap up this explainer, I want to leave you with your ultimate one-line summary mantra to repeat on exam morning. Sole equals one, partnership equals shared. It honestly is that simple once you strip away all the tricky distractors. You now have the exact mental framework to recognize these structures, to truly understand their massive liability risks, and to completely dodge the tricky wording the examiner is going to throw your way. So as you walk into that exam hall, ask yourself, when the examiner tries to blur the lines between personal risk and business reward, will you be sharp enough to see the trap before it snaps shut? Keep this battle plan fresh in your mind, and you absolutely will be. Thanks for hanging out with me on The Explainer.
Let's jump right in. If you're gearing up for the ACCA BT 1 exam, getting a rock-solid grip on the accounting equation isn't just, a nice-to-have, it is literally your secret weapon. This is the absolute bedrock of financial accounting, and believe me, the examiner is going to test whether you actually get it or if you're just memorizing a bunch of textbook terms. So in this explainer, we're going to tear apart the formula, expose the exact traps they'll set for you on exam day, and make your technique totally bulletproof.
All right, let's hit you with the ultimate one-line summary right off the bat. Assets always equal funding sources. Seriously, burn this into your brain. This one phrase, it's your North Star. When you're staring down a super tricky multiple choice scenario and you start to panic, this is what saves your grade. If you ever get lost, just remember this undeniable truth. Every single thing a business has, well, somebody had to pay for it.
Okay, let's rapid fire through the core definitions so we can actually make this equation work. First up, an asset. The definition is pretty straightforward. It's a resource owned by a business that provides future economic benefit. Now focus on that last part, future economic benefit. The examiner loves to try and trip you up by describing random resources. But listen, if it helps generate revenue or gives the business a benefit down the line, boom, it's an asset, period.
Moving on to capital. Simply put, this is the owner's investment in the business. It's the owner's funds. Think of it like the owner's personal skin in the game. It represents what the owner can claim from the business's assets, totally separate from any outside parties. So, when the boss throws their own hard-earned cash into the enterprise, that is your capital.
And to round out the big three, we have liability. A liability is strictly a future obligation that the business has to pay. It is the absolute responsibility to hand over cash or other resources to an outsider later on. If the business owes someone else, we're talking a bank, a supplier, literally anyone who isn't the owner, it's a liability.
Okay, moving to Section 1, the core logic, resources versus funding. So now that we've got the individual pieces, let's look at how they actually connect, because this is exactly where you pick up your exam works. Look, a business has resources, right? Those are the assets. But they don't just magically appear out of thin air. They've got to be paid for. They're either funded internally by the owner, that's your capital, or externally by outsiders, which are your liabilities. Every single penny has to fall on one of those two sides of the funding fence. Which brings us straight to the golden formula. Assets equals capital plus liabilities. This right here is the structural foundation of every balance sheet you'll ever see. Pin this to your mental bulletin board. The left side is what the business has, and the right side is exactly how it got funded. But hey, listen up, because here is exactly how the examiner is going to try to catch you out. You can't just memorize the standard form and call it a day. They are going to manipulate this formula algebraically just to see if you actually know what's going on. So you absolutely must be ready for the expanded form, which is assets minus liabilities equals capital. It's the exact same logic, just moved around a bit. Basically, if you take everything the business owns and you pay off everyone you owe, whatever is left over belongs to the owner. Makes sense, right? All right, Section 2, high probability exam traps. Pay close attention here.
Let's shift gears, because we are officially entering trick question territory. The examiner is going to throw these dynamic scenarios at you to see if your brain tracks how the equation moves in real time. So let's test your reflexes right now. What is the impact of taking out a loan? Say a business borrows 10,000 bucks. What happens to our golden equation? Think about it.
Let's reveal the answer. The impact is dual. First, the business gets an influx of cash, so your asset goes up. Awesome. But at the exact same time, your strict obligation to pay that money back to the bank goes up too. So your liability increases by the exact same 10 grand. Asset goes up, liability goes up. Both sides expand. And most importantly, the equation stays perfectly balanced.
Let's keep the pressure on. Here's your second classic exam scenario. What happens when the owner invests? Imagine the owner grabs $5,000 from their personal bank account and drops it straight into the business account. How does the equation react this time? Let's break it down. Just like before, the business gets cash, so your asset goes up again. But this time, the funding didn't come from a bank or an outsider. It came from the owner. That means the owner's claim on the business just got bigger, so your capital goes up. Asset goes up, capital goes up. The whole equation expands, and yep, you guessed it, it remains flawlessly balanced. So, the huge takeaway here, the universal rule you need to bulletproof your score is this. An increase in an asset must lead to an increase in the liability or an increase in capital. Or sure, sometimes a decrease in another asset. But the total balance of the equation, that can never ever be broken. It's like physics. Every action has an equal balancing reaction.
Moving into Section 3, fixing common mistakes. Let's make sure you don't do this.
You know the logic. But look, under the ticking clock of a real exam, people panic. The number one totally preventable mistake? Forgetting to balance the equation. I see students get so wrapped up in the weeds of a tricky transaction that they adjust one side, feel great about it, and completely ignore the other side. The fix here is absolute. Both sides must always be equal. If you work through a multiple choice question and your equation is lopsided, stop right there. You missed a step. Go back and find that missing piece.
The second huge mistake is not linking both sides. You'll read a transaction like, say, buying machinery on credit, and you only bother to write down the new asset. No way. You've got to track the dual impact of every single transaction you read. You need to be asking yourself every time, okay, my asset changed. What is the corresponding impact on my funding source? If you are religious about tracking that dual impact, the examiner literally cannot trick you.
And that brings us full circle, back to the ultimate one-line takeaway. I'm repeating it because it is that crucial for your reinforcement. Assets always equal funding sources, period. Whether you're looking at the standard form or the expanded form, whether it's an owner tossing in cash or a massive bank loan, this simple truth dictates every single movement in financial accounting.
So, I'm going to leave you with this challenge. When you sit down in that exam hall,
Are you going to let the examiner catch you slipping with an unbalanced transaction? Or are you going to rigorously track every dual impact, balance every single equation, and absolutely crush the ACCA BT1 exam? You've got the tools, you've seen the traps, now get out there, apply the logic, and pass this thing with total confidence.
Today, we're breaking down a core concept for your ACCA exams, the agency problem.
Okay, so what's the one big conflict that's right at the heart of every large company?
It's called the agency problem. It's when managers, the agents, start looking out for themselves, not the owners.
And really, it all comes down to this. The people who own the company aren't the ones running it.
So you've got shareholders wanting long-term growth, but managers, they might just be chasing a quick bonus.
So, for your exam, how do you spot this? Well, these keywords are your first big clue.
See words like self-interest or incentives? Your agency problem alarm bells should be ringing loudly.
And keep an eye out for these classic exam scenarios. They are total dead giveaways, trust me.
Think about a manager avoiding a risky but profitable project just to play it safe for their job. Or how about this? Gutting R&D just to make this year's profits look good for a bonus.
Now listen up, because this is a huge exam trap. You have to be super precise here.
Don't just call it a risk or ethics problem. It's a very specific conflict of interest.
So what's the fix? Well, companies use what are called governance mechanisms to get everyone on the same page.
You link their pay to performance, get independent directors to keep watch, and there's the threat of a takeover.
All right, let's wrap this up. Here's exactly what you need to remember for the exam.
It's the owner-manager conflict. It happens because they're separate. Spot it with self-interest. Fix it with alignment.
But here's something to think about. In the real world, can you ever really solve this problem completely?
All right, let's tackle a huge topic for your BT exam, the board of directors.
So who really runs a company? It sounds simple, right? But this question is everything in corporate governance.
You've got the owners, the shareholders, and then you've got the people actually in control, the managers.
And what happens when what they want doesn't line up? Well, that's where the trouble starts.
This clash is called the agency problem, and honestly, it's why corporate governance is even a thing.
So how do the owners fix this? They need a way to keep the managers in check, right?
And that's where the board of directors comes in. They're the essential bridge between the two sides. But their job isn't to get into the weeds of daily work. Nope, it's all about that big picture oversight.
Okay, lock these three things in your brain. Set strategy, monitor the team, and ensure accountability.
All right, let's talk about the exam. How does knowing this actually get you those points?
If you spot words like direction or oversight, your brain should scream Board of Directors.
Now, here's the #1 exam trap: mixing up the board's job with management's. Let's fix that. The board sets the direction. Management handles the day-to-day grind of making it happen.
If you remember just one thing, make it this: board equals direction plus monitoring. That's the magic formula.
So, if the board is the answer of why do things still go so wrong, a system is only as good as its people.
Welcome back to The Explainer. So glad you're here today because, wow, we have an absolute high-octane masterclass lined up for you. If you're prepping for your ACCA exams, specifically Business and Technology, BT, you are 100% in the right place. Today, we're taking a laser-focused look at a concept that's literally the bedrock of modern business law and accounting. We're talking about the company. We're going to strip away all that confusing jargon, look straight at the syllabus requirements, and make sure you have the exact, high-yield takeaways you need to walk into that exam hall with total, absolute confidence.
But, before we get bogged down in the dry definitions, let me hit you with a really high-stakes scenario out of the gate. Imagine this. If your business goes bankrupt, do you lose your house? I mean, it sounds like a simple yes or no, right? Common sense might tell you, well, yeah, if I own the business, obviously I'm responsible for its debts. But the law? The law sees it very, very differently, depending on the structure you've set up. Honestly, the single question is the dividing line between personal ruin and protected investments.
So let's get into Section 1. What exactly is a company? To answer that question about losing your house, we really need to look at how the ACCA BT1 syllabus strictly defines the whole concept of a company. And here's your foundational definition. A company is a separate legal entity owned by shareholders. Now, I really want you to focus on those first three words: separate legal entity. This is the absolute core rule. The company is completely distinct from the people who created it and the people who currently own it. It's almost like, well, it's an artificial person created by law.
And because it's completely separate, the company just keeps right on existing, even if all the original owners sell their shares, or, if the owners change completely. The owners come and go, but the company itself, it remains.
Which brings us to this golden rule. In a company, ownership does absolutely not equal management. The shareholders, they're the owners. They provide the cash, the capital, but they are not the same as the people managing the day-to-day operations. The owners elect a board of directors to keep an eye on things, and then those directors appoint the management team to actually execute the plan. Now, this separation is absolutely crucial for your exams because it creates what we call the agency problem, that classic conflict of interest between owners and managers. But for right now, just cement this one fact in your brain. The owners and the business are not the same thing.
All right, moving right along to Section 2, Separate Legal Entity Explained.
So we know a company is a separate entity, right? But what is that actually allowed to do out in the real world? Well, because the law treats the company almost like a living, breathing person, it can do 3 core things entirely in its own name. Number 1, it can own assets. That big factory, it doesn't belong to the shareholders, it legally belongs to the company. Number 2, it can take out loans. The bank lends the money to the company, not to the owners. And number 3, it can enter into contracts. When an employee gets hired, their contract is with the company itself. So the company essentially lives its own legal life. Pretty cool, right?
Which leads us perfectly into Section 3, Limited Liability Protection.
Okay, so if a company takes out loans and enters contracts in its own name, what happens when things go horribly wrong? This brings us to, honestly, what might be the greatest invention in the history of business, the incredible financial shield known as limited liability. Here's the deal. Shareholders lose only their investment, not their personal assets. Let's say you invest £10,000 into shares, and then the company borrows £1 million and goes completely belly up. Your maximum possible loss? Just that £10,000. The creditors absolutely cannot come after your personal house, your bank account, or your car to settle the company's massive debt. It is the ultimate protective barrier.
And this brilliantly illustrates the ultimate takeaway. Just lock this formula in your head right now. Company equals separate entity plus limited liability. That is the exact one-line summary directly from your syllabus notes. If you're sitting there and you see an exam scenario trying to trick you into making an owner personally pay for a company's standard debt, just pause, take a breath, and refer back to this exact formula.
Okay, Section 4. Let's look at a case study. The incredibly famous Solomon case. It's one thing to read about this theory in a textbook, but let's actually see how it works in a real court of law. Let's walk through the chronological drama of the landmark Salomon versus Salomon & Co. Limited case. So first, Mr. Salomon incorporated his bootmaking business. He owned almost all the shares, so it was basically a one-man show, right? But legally, it was a registered company. Second, the company hit some really hard times and went into liquidation, owing a bunch of money to creditors. Those creditors looked at Mr. Salomon and said, "Hey, this company is just you in disguise. You need to pay us from your own pocket." But step 3? Well, step 3 is where history was made. The court ruled that Mr. Salomon was actually not personally liable. Even though he ran the whole business and owned the shares, the company was a completely separate legal person.
So let's lock in the precedent established by that historic case with another quick one-line summary. Company equals separate legal person, distinct from owners. Seriously, no matter how closely an owner is involved with the limited company, that corporate veil stands firm. The debts of the company belong to the company. Full stop.
All right, let's shift gears slightly. Section 5, Public versus Private Companies.
Okay, so we totally understand what a company is now, but let's distinguish between the 2 main flavors of limited companies you're definitely going to be tested on. On one side, we have public companies, or PLCs. Their shares are traded publicly on a stock exchange, which means ownership is incredibly wide. Literally anyone can buy in. But because they're taking in public money, the regulation is extremely high. On the flip side, we have private companies, or LTDs. For these guys, share trading is strictly restricted. You usually can't just sell your shares to some random stranger without getting permission first. Ownership is limited to a smaller, much more controlled group, and because of that, the regulatory burden is way lower than a PLC. Now, I want to pause right here and warn you about a massive, very frequent exam trap. The examiner absolutely loves to throw a scenario at you to see if you're going to confuse a stock exchange listing with general private ownership. If a scenario talks about a company with a large number of investors, do not, I repeat, do not automatically assume it's a public company. The absolute key trigger word for a public company is that its shares are listed on a stock exchange. And the key trigger for a private company? Its share transfer is restricted.
Let's reinforce this crucial distinction with one final punchy little summary to memorize before you walk into that exam hall. Just say it with me.
Public equals listed. Private equals restricted. Keep that front and center in your mind, and I promise you won't fall for the examiner's tricks.
Almost at the finish line. Section 6, the ultimate exam summary.
We have covered so much ground today, really quickly. So let's rapidly summarize the exact traps the examiner is literally hoping you will fall into. Number 1, assuming owners and the business are the same thing. How do we fix it? By remembering the Salomon case, they are legally separate. Number 2, confusing listing with ownership size. Fix it by remembering that only public companies are actually listed. And number 3, ignoring regulation differences. Just remember that public money always equals heavy public regulation. Avoid these super easy mistakes, and you are securing yourself some really easy marks.
Before we go, I want to sign off with this final kind of provocative thought on the realities of what we've just learned. Is the corporate veil always fair to creditors? Think about it. If a company collapses and the owners just walk away with their personal wealth totally intact, suppliers might be left entirely unpaid. But remember, in the business world, this isn't some ethical flaw to sit around and debate. It is a known, accepted legal and commercial reality. Because creditors understand this exact risk, they adjust their terms, they demand higher interest rates, or they might even ask for personal guarantees before they lend to smaller companies. It's a whole system built on calculating risk. Keep that commercial reality in mind as you conquer your exams. Thank you so much for joining me on this explainer today. Stay focused, keep studying, and I will see you next time.
Hey there and welcome. So if you're deep into your ACCA business and technology studies, you already know that internal controls are a huge topic. But have you ever wondered what the one single component is that really underpins everything else? Well, let's get into it. So what do you think it is? Is it how many approvals you need for something? Or maybe how complicated your passwords are? Or how thick the company's procedure manual is? Nope, it's none of those. The real answer is actually way more fundamental. And the answer to that big question is this: the control environment. This is the bedrock, the absolute foundation of a company's entire system of internal controls.
Okay, get ready to memorize this one because this is the high-scoring definition you need. The control environment is simply the overall attitude of management towards control. That's it. It's not about the systems, it's about the mindset. And trust me, that exact phrase is pure gold in the exam. Now, this is a really key distinction to make. We're not talking about specific control activities here. For example, a control activity would be a rule that says all expenses over, say, $100 need a signature. The control environment, on the other hand, is about whether the manager actually looks at that expense claim before signing off, or if the whole culture is just so lax that people don't even bother getting the signature. It's the difference between having rules on paper and what actually happens in real life.
So let's really dig into this core idea, because once you get this, all the other stuff about internal controls just kind of clicks into place. It really all boils down to attitude.
This really says it all, doesn't it? This little formula from the study notes is perfect. Strong discipline from management leads directly to strong control. If the people at the top are lax, then even the best designed controls are just going to be weak.
You'll often hear this called the tone at the top. It's a classic concept in governance for a reason. I mean, just imagine a manager who's always cutting corners and telling their team to just get it done. What kind of message does that send? Now picture a manager who insists on following the procedure every single time, no exceptions. That seriousness, that attitude, it just cascades right down through the entire organization.
Okay, so the theory makes sense, right? But how does this help you get marks in the exam? Let's look at exactly how to spot the clues for the control environment in those exam scenarios.
So the examiner is going to give you signals. You need to be on the lookout for phrases like strict supervision. When you see that, a little light bulb should go on. That's your clue for a strong environment where rules are actually enforced. But on the flip side, if you read about careless management or a manager who just ignores the rules, that's a massive red flag. That points straight to a weak environment where controls are probably being bypassed left and right.
Here's a super simple 3-step process you can use for any exam question. First, just read the scenario and really look for those clues about how management behaves. Second, hunt for those signal phrases we just talked about. And third, based on what you find, draw a clear conclusion. Is the control environment strong or is it weak? And all of this brings us to our last and honestly most crucial point. Why is this one little component so incredibly important? Well, because it's not just another part of the system, it's the entire foundation. All right, here's the key takeaway for this whole explainer. If the control environment is weak, it literally does not matter what other controls are in place. You can have segregation of duties, authorizations, reconciliations, the whole shebang. They will all fail because the culture allows them to be bypassed. That is why you must look for this first in any internal control scenario. It decides the fate of everything else.
So to wrap things up, I'll just leave you with this question. The very next time you're doing a practice question and you see the words internal control, what's the number one, first thing you are going to look for? If your answer is the attitude of management, you have absolutely nailed it. Good luck with your studies.
All right, let's get right into it. Have you ever wondered what really stops a company from just falling apart? I mean, from total chaos. It's not just about having a great product or sharp managers. Nope, it's something working behind the scenes, a kind of hidden framework, and that's exactly what we're going to unpack today, internal controls.
You can almost think of it like a company's immune system, right? It's always on, working in the background, fighting off all sorts of threats. We're talking costly mistakes, outright fraud, you name it. It stops these things before they can do any real damage. And that, right there, is the power of a solid system of internal controls.
So, what's the goal here? Well, at its core, it's not just about one single checklist or one rule. It's a whole system, and it's designed to give what we call reasonable assurance. Now, pay attention to that phrase, reasonable assurance. It's super important. Why? Because no system is ever going to be 100% perfect, right? But a strong one? It gives the people in charge the confidence to know they're basically steering the ship correctly.
Okay, so here's the textbook definition. It's a system to prevent and detect errors, safeguard assets, and keep records accurate. But let's break that down. You've really got a two-part attack here. First, you prevent stuff from going wrong in the first place. That's your proactive game. But you also have to detect problems if they somehow slip through the cracks. That's your reactive game. You absolutely need both working together.
So let's kick things off with that first line of defense, prevention. I want you to think of this as your company's shield. It's the wall standing between your day-to-day work and all the crazy risks that are out there.
And the whole magic trick with preventive controls, it's all about one thing, timing. These are the things you do before the fact. They're the rules, the roadblocks, the things you put in place to stop mistakes or bad behavior dead in its tracks.
Look, it's as simple as this. You lock your front door before you leave the house, right? You don't wait for a burglar to get inside and then decide to lock it. You stop them from getting in, period. That's preventative control in a nutshell.
Okay, let's make this real. Think about getting a manager to approve a big payment. That's not just annoying paperwork, you know? It's a checkpoint. It prevents someone from spending money they shouldn't. And passwords, that's your digital bouncer. But the big one, the one you really need to know, is segregation of duties. It's a simple idea. Don't let one person control a whole process from start to finish. That makes it way, way harder for someone to commit fraud.
But hey, let's be real. No shield is perfect. Things are going to slip through. So, what happens then? Well, that's where your second line of defense kicks in, detective controls. If preventive controls are the shield, think of these as your scanners or your security cameras finding trouble that's already gotten past the front gate.
So now, the focus flips completely. We're not trying to stop something anymore. We're on the reactive side now. The only job of a detective control is to find issues after they've already happened. This is so important because it lets you fix the problem before it snowballs into a total disaster.
This is just like reviewing the security tapes after a break-in. Yeah, I can't undo the break-in, but you better believe it's going to help you figure out what happened, how to fix it, and how to make damn sure it doesn't happen again. And the tools for this are things you probably see all the time. Checking reports, right? If your budget report shows you spent way more than you planned, that's a detective control flagging a problem. And a bank reconciliation? That's classic detective work. It's like a financial CSI, matching your company's books to the bank statement to find any weird transactions that don't add up.
Okay, theory time is over. You think you've got it? Let's find out. I'm going to throw a few quick scenarios at you. Your job is to tell me if it's preventative, the shield, or detective, the scanner. You ready for this? Let's go.
Scenario 1. A manager has to sign off on a payment before it's made. What is it? Preventative or detective? Think about the timing. When is it happening?
That's right. It's preventive. Of course it is. It's happening before the money goes out the door. It's a gatekeeper stopping a problem before it starts. Nicely done.
All right, next one. At the end of the month, an accountant does the bank reconciliation. What do you think? Shield or scanner? Preventative or detective?
Yes, it's detective. Why? Because all those transactions have already happened. They're in the past. This whole process is about looking backward to find errors that have already occurred. Perfect.
Okay, last one. Let's nail this. A computer system requires a password to get into sensitive files. Is that a shield or a scanner? Preventive or detective?
Bingo! 100% preventive. It stops someone from getting in before they can do any damage. It's a digital lock on the door. Fantastic! You've totally got this. You know the difference between your shields and your scanners.
So if you forget everything else we've talked about, please, just remember this one thing. It all comes down to one simple golden rule.
Preventive is before. Detective is after. That's it. If the control stops something from happening, it's preventive. If it finds something that has already happened, it's detective. Remember that, and you'll be set.
So I want you to take this back with you. Think about your own team, your own company. Ask yourself, how strong are our shields? And how sharp are our scanners? Because honestly, in business today, you can't afford to be weak in either one of those areas. You just can't.
Right, let's get straight into it. Welcome to this incredibly high-yield explainer. Look, if you're hunting for a fast-paced, high-energy revision sprint focused entirely on securing those guaranteed easy marks in your ACCA business and tech exam, you are absolutely in the right place. Honestly, I literally can't tell you how many times I've seen incredibly smart students drop careless marks on this specific topic simply because they were rushing. So today, we are laser-focused on a single, highly testable concept straight from the BT1 notes, the outsourcing exam trap. We're going to break the whole thing down, spot the examiner's sneaky little tricks, and make absolutely sure you never drop a mark on this topic again. Let's get moving.
So I want to start by throwing a fundamental question right at you. What exactly is outsourcing? I mean, it sounds like one of those basic business buzzwords, right? The kind of thing you hear in the corporate world every single day, usually over some stale coffee in the break room. But listen, do not underestimate this one. This simple concept is literally the gateway to the ultimate exam hack for this paper. The examiner knows that students take this word for granted, and that is exactly where they lay their traps.
Well, let's strip it right back to the official definition from the source notes. Outsourcing is using an external party to perform business activities. I really need you to burn that exact phrase into your brain. External party. I'm heavily emphasizing this because it needs to become an automatic trigger for you. When you're sitting in that exam hall, stressing, reading through a dense scenario, the very millisecond you see the word outsourcing, your brain should literally scream external party. It is the absolute foundation of everything we're talking about here.
Okay, so what does this actually look like in practice? It's usually super clear-cut. Think about the absolute classic, high-probability exam scenarios you're going to face. Payroll services outsourced. IT services outsourced. Just rapidly fire these right into your memory. And why these two? Well, because they're standard business functions that companies constantly hand over to specialists. Mostly because, let's be honest, nobody actually wants to do their own payroll math. If you're reading a question and the scenario says the company hired a completely separate third-party firm to run their monthly payroll, or some outside tech company to manage their servers, boom, you've spotted the exact keywords. You know for sure you're dealing with a legitimate outsourcing scenario.
But, whoa, stop right there. Listen to me very, very closely for a second here, because I need to issue a massive warning. We are entering the internal versus external trap. This is it. This is the exact trick the examiner uses to reach right into your paper and steal your hard-earned marks. They'll set up a scenario that sounds like outsourcing, it feels like outsourcing, but they are baiting you. They just want you to rush, misread the situation, and fall straight into the trap.
So how do we beat the trap? You absolutely have to spot the difference here. Passing a task to an entirely external company. Yes, that equals outsourcing. We've got that down. But here is the kicker. Internal delegation is not outsourcing. I am begging you, do not ever mix these two up. If a manager takes a task and simply passes it down to another department within the exact same company, or just delegates it to a junior team member down the hall, guys, that's just internal delegation. No matter how fancy or complex the examiner makes it sound, if the work doesn't leave the building and go to an entirely separate external company, it is absolutely not outsourcing.
All right, bringing it all together, it all boils down to one single golden rule. Outsourcing equals external work. Say it with me in your head. Outsourcing equals external work. That is literally it. If the work goes external, it's outsourcing. If it stays internal, it's just delegation.
Take that unshakable confidence right into your exam, look out for the examiner's tricks, and absolutely smash those easy marks. But hey, before we wrap up this explainer, I want you to chew on this. In today's gig economy, if a company hires a freelance contractor to physically sit inside their office and work on their computers, is that internal delegation or external outsourcing? Keep that in your back pocket as you study.
Right then, let's get started into it. We're going to dive into one of the most fundamental ideas in business, and we're going to do it fast. This is the stakeholder playbook. So let's kick things off with a big question, shall we? Is a company's one and only job to make a profit for its owners? Is that it? The whole reason it exists? A lot of people think so, but let's challenge that. If you think that, you are completely missing the point. It's so much bigger than that. The real game is about stakeholders, and you've got to know the playbook, or you are going to get left behind. Okay, so where do we start? Section 1. Let's figure out who really matters here. This is all about understanding the entire world a business lives in, not just the corner office. So what even is a stakeholder? Well, let's get the definition straight. It's any person, any group that has an interest, a stake in what a company does. If a company's decisions affect them, for good or for bad, they're a stakeholder. Simple as that. And look, we're not talking about some abstract idea here. These are real, tangible groups of people. You've got your shareholders, of course, the owners, but you've also got the employees actually doing the work, the customers buying the stuff, the government setting the rules, the suppliers providing the raw materials, and even the local community where the business operates. They all have a vested interest. All right, now this is where it gets really interesting. And honestly, really tricky. You see, all these different groups, they all want different things. And that sets up what I call the great stakeholder tug of war. Let me show you the textbook example, the one you see everywhere. Shareholders, right? They want more profit, bigger dividends. To get that, you often have to push costs down. But then you have the employees. They want better pay, they want job security, which pushes costs up. See the problem? It's a direct conflict. You can't just give both sides everything they want. That's a core tension you'll find in almost any business. So you're probably thinking, how on earth do you manage all that? You can't keep everyone happy all the time. You need a system, a tool to help you prioritize. And the first one you absolutely need to know is the Mendeley matrix. Now, what I love about this is how simple yet powerful it is. It's just a grid. It plots every single stakeholder based on two things. How much power do they have over the company, and how much interest do they have in what it's doing? That grid gives you 4 boxes, and each box tells you exactly how to act. And here's how you actually use it. It's a simple 4-step playbook. First, you list all your stakeholders. Second, you assess their power and their interest. Third, you pop them into one of the 4 boxes on the matrix. And fourth, this is the crucial bit, you create a strategy. Are they a key player you need to work with closely? Or someone you just need to monitor? This is how you stop running around trying to please everyone and start focusing your energy where it actually counts. And that's the bottom line. You can't treat everyone the same because they aren't the same. Your time, your resources, they're limited. Power and interest are the 2 magic ingredients that tell you exactly where to point your attention. All right, so the Mendeley matrix helps you prioritize. But what if you want to go deeper? What if you want to build your entire business strategy around your stakeholders? Well, that's where we bring in the big guns, the performance prism. This thing is brilliant. It has 5 connected sides, 5 key questions. It starts with the stakeholder. Who are they and what do they want? From there, it just flows logically. What strategies do we need to deliver that? What processes do we need to make those strategies happen? What capabilities, people, tech, do we need for those processes? And then it flips the whole thing on its head and asks, what do we need from them? It's a 2-way street. And that's what makes it so different. You know, other tools like the balanced scorecard, they're pretty good, but they tend to focus on just shareholders and customers. The performance prism forces you to think about everyone, your employees, your suppliers, the government regulators, the whole shebang. It gives you a true 360-degree view of your business. This really just nails it. It's not a one-way street where the company just gives. It is a reciprocal relationship. For the business to thrive, it needs things from its stakeholders just like they need things from the business. So let's wrap this up. Let's pull all these threads together. After all this, how do you actually master this incredibly complicated balancing act?
Well, for starters, you avoid the classic blunders. You don't just focus on shareholders. That's a recipe for disaster. You don't ignore the conflicts hoping they'll go away because they won't. They'll explode. You absolutely don't treat everyone the same. You have to prioritize. And maybe most importantly, you stop seeing stakeholders as a problem you have to manage and start seeing them as your single greatest source of value.
Which, brings us full circle right back to that very first question we asked. After all this, what's the real answer? Who does a company truly serve?
Here's the answer. A company serves everyone it depends on. A business that only looks out for its owners is brittle, it's short-sighted, and it's built to fail. The real modern business understands it is never, ever a solo act. It's a complex, difficult, and absolutely vital balancing act.
All right, welcome to The Explainer. So let's talk about something big. When a company absolutely crushes it, who actually gets to decide what happens next with all that success? Let's get into it.
Okay, I want you to picture this. You're the CEO. You've just had a monster of a year, a record-breaking year. The profits are just huge. Your company is literally swimming in cash. The pressure? It's all on you. Everyone is looking right at you. So, what do you do now?
So, you've got two pretty great choices on the table. Do you plow that profit back into the business for future growth? Build a shiny new factory, maybe develop some game-changing new product? Or do you turn around and reward the amazing team that made it all happen with some massive bonuses? Look, they're both fantastic options. But here's the kicker. You probably can't do both. So who makes the call?
And right there, that question, it gets to the heart of the matter. See, this isn't just some numbers on a spreadsheet business problem. No, it's a people problem. And to even begin to figure it out, we need to talk about a really important group. We need to meet the stakeholders.
So what on earth is a stakeholder? Well, it's actually pretty simple. Think of it like this. It's anyone who has a stake in the game. Any person, any group. Basically, anyone who has an interest in what your company does because, and this is key, your decisions are going to have a real, tangible impact on them.
And what's kind of mind-blowing is just how big this group really is. We're not just talking about the shareholders, the owners with the stock certificates. We're talking about the employees who are in the trenches every single day, the customers who vote with their wallets, the government officials who lay down the law, even your suppliers, your partners. And hey, let's not forget the community, the actual neighbors who live next door to your factory. Every single one of them has a stake. Okay, so this brings us right to the main event, the central conflict. You've got all these different people involved, so the big question is, what does everybody want?
And here is the problem. The whole shebang, right here. Every single one of them wants something different. And it's not just that their goals are a little misaligned. Oh no, a lot of the time they are in completely opposite corners.
So yeah, this is where things get interesting. You're basically setting the stage for a massive, inevitable clash. It's a headache every single business leader has to deal with. Let's look at the most classic example of this.
The source material from the ACCA really nails it. It says different stakeholders have different interests that may conflict. And let me tell you, they're not saying may as in it might happen. They mean may as in, oh, it's absolutely going to happen. It's a certainty.
And this right here is the perfect picture of that conflict. On one side, you have the employees. What do they want? Higher salaries, better benefits. And hey, who can blame them? That's a totally reasonable thing to want. But on the other side, you've got the shareholders. They want higher profits. Why? Because that means bigger dividend checks and a stock price that's going through the roof. Think about it. Every single dollar that goes into an employee's paycheck is a dollar that doesn't go into the profit column. It's a classic tug of war.
So if you can't possibly make everyone happy, what's a CEO to do? Well, here's the secret. You don't pick a side. It's not about that. Instead, your job becomes a great balancing act.
You see, the goal here isn't for one group to win. If the shareholders always win by maximizing profit no matter what, your company's reputation could get absolutely torched when the story about how you did it breaks, and trust me, it will. Suddenly, your ethical customers are gone. Your best employees, they might quit in protest. All of a sudden, that cheaper decision just got very, very expensive.
It all comes down to finding that delicate balance. So the company can make a different choice. They could go with a more expensive but more ethical supplier. Sure, profits might be a little lower in the short term. The shareholders might have to, adjust their expectations for the next quarter. But
Now your employees are proud of where they work, your customers are loyal because they believe in your brand's values, and the company as a whole is building something way more valuable, long-term trust.
And that right there, is the reality of leading a business today. It's not about finding one single magic right answer. It's about navigating this incredibly complex web of competing interests, all of them legitimate, by the way, to build a company that's strong enough to actually last.
So what's the big takeaway from all this? Well, it's this. A company is not just some machine for printing money for its owners. It's more like a living, breathing ecosystem. And its survival, its long-term health, depends completely on its leaders' ability to manage all those conflicting needs, to find that absolutely crucial, delicate balance. Which, brings us right back to where we started, but now we're looking at it a little differently. Maybe the real question isn't who runs the company, maybe it's who does the company really work for? Is it the shareholders? Is it the employees? The customers? Or is the real answer just a little bit of everyone? Now that is something to think about.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this Masterclass Explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy.
Let's kick things off with Section 1, ultra-fast revision.
All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom, adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in.
Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately.
Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental. The examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on. Let's keep this intense pace going. Notice how quickly we can switch contexts here, just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BAR-DR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be.
So, why do good students fail ACCA exams? Think about that for a second. They know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now.
Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out.
Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value.
Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3. Practice strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank. Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this.